All right, Michelle, it looks like it worked that time. I know we sometimes have a lag. Can you let me know when we're actually up and running on YouTube?
I'm seeing it up and running now, so you're good.
Very good. All right. Well, we're gonna go ahead and get started then if everybody's ready. All right, this is Chair French. I am convening the virtual workshop session that we set for November 20th, 2024. The topic of this workshop is capital structure and return on equity and how those are treated within Evergy's revenue requirements in a rate case. This is related to docket 23 EKCE 775 RTS. And we will have presentations by Evergy representatives, Darren Ives, Jeffrey Lay, Brian Buckler, and we will also have presentations by Mr. Todd Shipman, Daniel Ford, Todd Shipman and Daniel Ford. Um, I think what we're going to do to start off, we have a few folks on the call that are not presenters, but may be interested in asking questions. And so I just wanted to get some introductions out of the way. Um, Let me call on the few folks I see that are not either presenters or KCC staff. I will begin with Mr. Mike Gorman.
Good morning, Mike Gorman. I'm with Brubaker and Associates representing Kansas Industrial Consumers.
All right, thank you. Good morning, Mike. Molly Morgan.
Good morning. I'm an attorney at Folston, and I'm here on behalf of KIC.
All right, good morning, Molly. And Jim Zakura. Do you have your sound up and running?
Better?
Yep, we hear you now.
Good morning, Chair French. Jim Zakor on behalf of KIC, and our expert consultant will be speaking on behalf of KIC, and that is Mr. Mike Gorman.
Okay,
Jim,
thank you.
we could see about half of your face on camera. If I don't know if that's your good side, but just if you may want to sit in a different position.
Thank you,
Thank
Brian. I'm
you.
still searching for my good side. Thank you.
So I think that is everyone that is not either a presenter or KCC staff. At this time, I'm going to turn it over to Mr. Justin Grady. And he's with KCC staff. He's going to give kind of an overview of why we're here. And then Justin, if you want to give an introduction of any other KCC staff that are on the call, you can, but give us some context of why we're here before we turn it over to the presentations.
Yeah, good morning, Chair French, Commissioners Keither and Keene, and anybody else that's joining us online as well. I had intended to introduce the other staff members on the call, but thank you for stealing my thunder, Chair French. I'm joined this morning also by Jeff McClanahan. He's the Director of Utilities, and Adam Gatewood. Adam is our long-standing, long-tenured staff expert on return on equity and capital structure issues. So you may very well hear from Adam and potentially Jeff as well this morning. So with that, yeah, good morning. Like I said, my name is Justin Grady. I'm Deputy Director of the Utilities Division. And what I hope to do this morning is just kick us off with a real high level overview of why we're here, and some of the history of this issue and why we're asking so much of your time this morning. From staff's perspective, this particular issue with this particular utility really started when the commission approved the revised merger agreement between KCBL and Westar, that the two predecessor utilities that formed Evergy in the 18095 docket. Part of the financing plan in that docket was to balance the capital structure of the holding company, the newly formed holding company, by issuing around $1.1 billion of long-term debt, holding company debt, and then using that debt to buy back the utilities' equity. From staff's perspective, we felt like we were, up front in that case, in that we always intended to utilize and recognize that holding company debt for rate-making purposes which from our perspective is in line with our previous policy of utilizing the least cost capital structure that's reflective of utility operations, financing utility operations in order to set rates. Obviously, the company had a different perspective, and it's not my intention at all to relitigate all of the arguments that came out from that merger and from the rate case. I'm trying to be as neutral as I can and just provide the context, the historical backdrop and context of the issue. In April of 2023, Evergy filed its first rate case after the merger, after a 5-year rate moratorium, and that was in the 23-775 docket that the chair referenced earlier. As expected, they filed the rate case using their operating utility capital structure, which I think the utility would refer to as their actual capital structure at the operating utility level. And that capital structure contained around 52% equity. When staff filed our revenue requirement position in our direct testimony, we reflected and recognized the existence of that holding company debt in our revenue requirement calculations. And that resulted in an equity layer of approximately 48%. The revenue requirement impact of our capital structure adjustments, when you consider the difference in our opinion on the actual required return on equity for equity investors, was about $89 million between the two utilities. And so, you can see why this issue is it garners as much attention as it does, and why it's as important as it is to the utility's equity and debt investors, as well as to the utility's customers. And that's why, consumer advocates and large utility customer advocates or representatives, why those entities have as much interest in this topic as they do. It tends to be one of the most controversial and significant monetary issues in every rate case that comes before the commission. Ultimately, we did settle the rate case, as you know, commissioners, with staff agreeing to an equity layer of between 50 and 50.3%, and a return on equity of between 9.4 and 9.5%, depending on how you do those calculations. Ultimately, what we agreed to was an after-tax weighted average cost of capital. And so there are there's some interpretation and some interpolation that has to occur in order to actually come up with where you think the capital structure and return on equity landed in that rate case. If you fast forward then to the next legislative session, Evergy filed a bill with the legislature, House Bill 2527. And one component of that bill would have required the commission to utilize the actual capital structure of the operating utility, regardless of what the explicit cost of that decision was for ratepayers. The other section of the bill would have required the commission to use the average return on equity from all litigated decisions over the past 12 months, as reported by SNL and RRA, which is a division of S&P Global. That average litigated return on equity would be from all states, regardless of whether those states faced, say, expedited wildfire risk or some other type of risk that we don't face in Kansas. Staff's calculations at the time when we testified in response to that bill, our calculations were that had that legislation been in effect prior to the previous rate case in the 23-775 docket, that would have increased rates around $38 million between the two utilities from higher than the settled result. So as you can imagine, we were adamantly opposed to that section of the bill, which would have removed the commission's authority to set rates on capital structure and return on equity. Ultimately, the negotiations that occurred, during that legislative session, which were detailed and comprehensive, allowed all parties to agree to a revised bill that ultimately removed those capital structure provisions. But in order to really get Evergy to agree to remove those capital structure provisions, Evergy requested that all parties agree to a workshop before the commission so that this issue could be discussed, in a less formal fashion and outside of a litigated proceeding. And so that brings us to today. That's why we're here, and that's as neutral of a recitation as I can provide of the history and some of the background of the issue that led us up to today. So with that, I appreciate the opportunity to provide that overview, and I will pass it back to you, Chair French, to introduce the first Evergy representatives. Thank you.
Sounds good. Thank you, Justin, for the context. I think that's a helpful refresher for all of us. Well, I'm not going to make introductions. I'm going to let the company do that because I know who our presenters are, but I see we've got the CEO on here. So, Mr. Campbell, I don't know if you're kicking us off or if I'm kicking Mr. Ives, but I will turn it over to the company and let you run your presentations however you'd like. I do want to say just one word about structure. We have several presenters. We will let each of you make your presentations. I do expect to probably take a break somewhere maybe in an hour and a half or so. Give everybody a short break. As far as taking questions during your presentations, my plan is for potentially the commissioners may interrupt you and ask some clarifying questions, or Mr. Grady may, but I will ask that most of the questions be held until in between the speakers so that we've got sort of logical stopping points when each person finishes their presentation. And then I'll open it up for questions from all the parties in between each of the speakers. So that's how I see the structure going. If there's anything else you all need, I'm happy to clarify, but that's my hope for how this goes. And I'll toss it to whoever wants to introduce all of our presenters today.
Chair French, thank you very much. This is David Campbell. I'm the CEO of Evergy, and thank you, and thanks to Commissioners Keene and Keither for your time today, and thanks everyone for your time today for this discussion. We really appreciate it, especially 4 hours in a busy time of year. We appreciate the opportunity to really just present information on an important topic. And Justin, thank you for that introduction and description of an issue that is an important one. So we thought having an opportunity to discuss it in this setting outside of a litigated proceeding would be the perfect way to talk through an important issue and just provide information around it. So I will hand it off to our speakers. We have several from the company. So Darren Ives will lead off. Our head of regulatory, Darren well. Jeff Lay, our treasurer, will then speak, and Brian Buckler, our chief financial officer, will follow. And we have a couple of outside speakers who we thought it'd be helpful to have some folks with some experience from the debt and equity capital markets. So we have Todd Shipman, who has had a long and distinguished career at S&P, so understands things from a rating agency perspective, and Dan Ford, who was one of the leading equity analysts in the sector for a long time. So they will also be speakers in the presentation. So again, really appreciate your time today. We welcome the questions that you have over the course of the discussion or in the break. So please raise questions if you have them. And with that, I will hand it over to Darren.
Thanks, David. Can everybody hear me okay?
We do. You're coming through loud and clear.
Perfect. So as David mentioned, and I just want to echo, I want to thank all the parties today for being here, for giving us the opportunity to advance this dialogue on investment opportunities for reliability and economic development in Kansas, and to talk about the importance of fair and reasonable capital returns, both the appropriate capital structure to be used and the rate of return to be provided in, creating the ability to attract and obtain investor capital that's going to be needed to make these important investments in Kansas. I don't know if the presentation's up. but I was going to move to slide 2.
It
Slide
is
2.
not up yet. I don't know if you all are sharing it on your
Yeah, we're
end
gonna.
or
Yeah,
okay.
I'm sorry, Chair. We're getting it pulled up here, and then
Okay.
we'll navigate through
Very
once we get
good.
it up here. On slide 2, and I'll go ahead and start because slide 2 is really the agenda, and David laid some of that out. I would say, first I'm going to start off by expanding a little bit on some of the history and the background that Justin provided. And then I'm going to I'm talking about the current historic, at least in my belief, economic development opportunity that we're seeing in Kansas and really across the country, and the need that creates for infrastructure investment, and as a result, that the access that we need to reasonably priced investor capital to make those investments. I'm going to hand it over to Jeff Lay. After that, Jeff is our Vice President of Corporate Planning and Treasurer. Jeff's going to talk a little bit about capital structure and return on equity rates and their fundamentals, describing the role they play in Evergy's business and their importance to our long-term plans and for the long-term benefit of the state and for all Kansans. We're then going to turn the presentation over to Brian Buckler. Brian recently joined Evergy as Executive Vice President and Chief Financial Officer. We're excited to have Brian on board. We look forward to tapping his years of industry financial experience. Brian's going to review the current comparability of return on equity rates and capital structures in the industry and the importance of having comparable capital returns and attracting capital, and how that comparability gives us the opportunity to invest at Kansas at levels that are going to be sufficient to support the state's interest and opportunity and economic development, as well as reliable and affordable service to all of our Kansas customers. And David did a pretty good job of introducing our last 2 presenters, Todd Shipman and Dan Ford, and I know they'll both give an overview of their background and experience when they start their presentations. So with that, maybe we'll move to slide 3. Justin covered quite a bit of the background that's on this slide. I mean, I guess I would emphasize the first bullet. We really are seeing a generational opportunity for Kansas economic growth that we're going to discuss further in my next section. While House Bill 2527, the legislation that was passed that Justin referred to, is certainly supportive for investment by Evergy and positive in the eyes of our investors, there are some concerns that remain as to whether Kansas is going to provide competitive return on equity and capital structure returns at this time of need for investor funds in the state, which is, in large part what has brought us to today's discussion. If we move to slide 4, concluding the 23 rate case, I provided this testimony that's listed on here, but what it really did was describe and highlight that while we were pleased to resolve that case in a settlement, we felt strongly that we needed to continue the dialogue on supportive policies in Kansas to provide us the financial strength to be a good partner in future economic growth opportunities for Kansas. We're excited that we're advancing that today. Slide 5. Slide 5 portrays the rankings of state regulatory jurisdictions through the lens of assessing the constructiveness of regulatory treatment of utility investors as assessed by a group called the Regulatory Research Associates. This assessment is considered by debt credit rating agencies, by equity investors and analysts in evaluating their investment opportunities across the utility space. Prior to the passage of House Bill 2527, Kansas was ranked in the 3rd column from the right on this chart, which is listed as below average /1. on the RA scale. This had Kansas placed in the bottom 10 of constructive regulatory treatment in jurisdictions across the country. Fortunately, after the passage of House Bill 2527, RRA recognized the constructive outcome of that legislation and increased Kansas ranking to the fourth column from the right, or average/3. This positive move reflects the improved investment opportunities in Kansas due to some of the fundamentals of that legislation. However, even after that move, there remain 34 jurisdictions that are seen as more constructive for investors than Kansas. One of the key concerns that remains for investors is whether Kansas is going to provide competitive capital returns to investors consistently as we move forward in this time of historic investment opportunity, not only for Kansas, but across the country. As we move to slide 6, a couple of regulatory principles that I'm going to try and touch at a high level without getting too deep in the bowels of regulatory treatment. But these principles are important to the rate of returns that get set in a case, and ultimately to the capital structure discussions that we're having today. For the rate of equity return, there are a couple of long-standing U.S. Supreme Court decisions that have established the framework for assessing those equity return rates. Collectively, they're referred to as the Hope and Bluefield. In summary, these cases establish 3 standards of assessment in determining fair and reasonable rates of return in a regulated utility rate case. The first is referred to as the comparable risk standard. It basically says that the rate provided should be comparable to the returns that investors would expect to earn on investments of similar risk in other companies. The second is called the financial integrity standard. This standard says that the rate needs to be sufficient to assure investor confidence in the utility's financial integrity moving forward. And the third is the capital attraction standard. This standard indicates that the rate provided should be adequate to maintain and support the company's credit and to appropriately attract investor capital. When these 3 are evaluated together and effectively met, these standards are intended to ensure investors that they will receive a fair and reasonable opportunity for return if they invest in the utility. As we move to slide 7, there's a regulatory standard that also applies as we think about the application to capital structure. It's a long-standing principle called the standalone principle. In summary, in applying the standalone principle, it says that the revenues and expenses of the operating regulated utility are what should be considered for purposes of determining the revenue requirement and rates to be recovered from customers. Should not include the revenues, expenses of the holding company of the utility or of other affiliates of the operating utility. When this is evaluated, there are also 3 prongs that are looked at for the standalone principle when you're looking at capital structure. The first that's often looked at in jurisdictions across the country is that the operating utility issues its own debt instruments. The second is that the operating utility is rated as a standalone entity by a credit rating agency. And the third prong is that the operating utility's actual capital structure is reasonably consistent with the capital structures previously approved by the regulator and those of comparable companies evaluated. If all 3 of these prongs are met, which is true for all of Evergy's operating utilities, then almost universally across the country, the operating company's standalone capital structure is deemed most appropriate for rate-making purposes. Wrapping up this section, on the next slide, while Kansas has historically been rated low in constructive regulatory treatment for investors, the legislature's passing of HB 2527 this past year was certainly constructive for utility investment. Investors have recognized it as such. That said, we do still see some concerns from investors about capital return competitiveness in Kansas. Consistent competitive returns to those of our peer utilities are necessary and essential to provide the access to adequate and affordable capital to allow Evergy to make the supportive investments for growth in Kansas. So if we turn to the next section, I'll spend a little bit of time starting on slide 10, looking at what I've talked about or referred to as the historic economic development opportunity that sets out in front of us. If you read industry articles and assessments on a almost daily basis like I do, you know you can find new articles daily on large load growth opportunities across the U.S. and the implications of this growth on the electric utility industry across the board. The charts shown here on slide 10 show that while the growth CAGR for manufacturing, as you look at the chart on the left, has been solid historically at about a little over 7% over a 15 or so year period, it's really exploded in the last couple of years. Led, as you can see by the chart on the right, which is that same chart broken down by some critical sectors, it's really led by the computer, electronics, and electrical industry segment, which is showing substantial, I'll call it a hockey stick growth starting in 21 through current. This really reflects the onset of artificial intelligence, cloud computing, as well as the reshoring of advanced manufacturing in the United States. As we move to slide 11, that slide takes this data and kind of drills down to focus a little bit on the potential impacts on the industry of artificial intelligence and data centers to support the growth in that space. The takeaway on this slide really is that the forward projection of the computing industry share of usage of total U.S. power demand grows from about 4% of total demand in 2023 to an expected 8% of total U.S. demand by 2030. A real seismic change in the needs and requirements for energy from the electric utilities. As we move on to the slide on page 12, it actually shows that nationally where we're seeing, it shows the pockets where we're seeing large load growth, and it demonstrates that in Kansas, we're already starting to see some penetration, with the most prevalent example being our success in Kansas of attracting Panasonic to the state. With this win, we've been in discussions not only to bring Panasonic online, but with other large loads for the potential for them to locate in Kansas. As we move through to slide 13, it continues to hone in on the opportunity for Kansas and the region, as this analysis actually lists Kansas City and the surrounding region as a top tier 2 city for computing large load location opportunities. The assessments in this study is based upon access to fiber and reasonable energy cost. We're certainly experiencing the interest from prospective new customers in our service territories. So move to slide 14, we'll drill down on that just a bit. Slide 14 really focuses in on Evergy's current pipeline of large load customers. As we look at our solid pipeline today, it includes a little over 20 customers that on an aggregate basis would add at full load more than 6 gigawatts of incremental demand on our system. For reference, across all of our Evergy jurisdictions today, our comparable existing peak customer demand is a little over 11 gigawatts. So 6 gigawatts setting in the queue and looking to come in would be a substantial growth across our territory. As noted on the slide, in addition to just new electricity load and an ability for these new customers to share in the overall cost of our Evergy electric system, there are a number of other benefits for Kansas and the region by bringing these large loads into the territory. Job creation, a larger tax base, and development of supportive businesses and services coming into the region, just to name a few. As we note on slide 15, though, to unlock this opportunity and to support Kansas's economic development goals, Evergy will need to make some substantial investments in our system to support the electricity need of all Kansans. These investments will require us to have access to competitive priced debt and equity from investors as we finance these new investments. As we move to slide 16, on our company's third quarter earnings webcast, we announced an updated 5-year capital plan for Evergy based upon our system needs and forecasted investment requirements that now totals $16 billion over the years of 2025 through 2029. This plan reflects both needed investments in new generation, expanded investment in our local wires, and continuing levels of investment to support our transmission system and our existing infrastructure today. While this plan reflects growth in our investment needs, it still benchmarks at just under the investment spending trajectory of our peer utilities and should help us remain in a very good position as we continue to balance our focus on affordability and reliability of our service. Moving to slide 17. Slide 17 demonstrates that at this level of forward investment, we're going to have over $7 billion of need for incremental investments from our debt and equity or investor dollars. Our access to these affordable funds will be directly impacted by the ongoing policy in Kansas and the need to provide competitive capital returns to Evergy through fair and reasonable return on equity rates and utilization of our actual capital structure in line with the peer utilities with which we're going to be competing for those investor dollars. So concluding my section on slide 18, Kansas and ultimately in its supportive role, Evergy, are in competition for new prospective large load customers, just like Panasonic. These customers value reliability and speed to market with their new facilities. Timely addition of new customers and our ability to gain their business in Kansas is going to require investment by Evergy, which requires us to have access to that competitive priced investor capital. Fair and reasonable capital returns in the regulatory process will provide that access and allow Evergy to be supportive to this historic economic growth opportunity in the state of Kansas. With that, those conclude my remarks, and Chair, I'd pause and stand available for any questions on this section.
Great. Well, thank you so much, Mr. Ives. I'm gonna start looking for hands that pop up. If people can use the raise hand feature on Zoom. If you can't find it, you can wave your hand on video or you can come off of mute. But to give people a little time, I'll ask a couple questions just to see if we can give people some time to come up with some others. So a couple quick questions. Back on slide 7, if you have the ability to go back to that, I don't know if it's essential, but there is the 3-prong test that you mentioned here. That kind of gets to the crux of the issue we're talking about. I'm an attorney by trade, and so I love a good 3-prong test or a factor analysis. Is this memorialized somewhere in, I know you've mentioned the Missouri PSC and the Federal Energy Regulatory Commission. Is this memorialized as a presidential test that they use? Is it enshrined somewhere in case law, either in Kansas courts or federal courts? Where would we find this test?
Yeah, I think thanks for the question. As you know, I am not an attorney by trade, so I will speak a little out of tune here, but I believe that this three-prong test is in some case law that's been utilized, particularly at FERC. There's some other states, I think, that utilize the foundation of this too, but FERC has certainly recognized these three prongs as being important to their assessment of capital structure. And I think on a broader scale, when you step back from capital structure, I think a number of states have talked about the utilization of operating company revenues and expenses in evaluating revenue requirements rather than costs from affiliates or costs from holding companies.
And I guess this is more of a regulatory theory question. I mean, is it your view that this is probably a more granular or restrictive test, but it probably should or should not override sort of the more overarching Hope and Bluefield standards?
Yeah, I think they really kind of work in tandem. I think Hope and Bluefield kind of talk about kind of the rate and the opportunity for a fair, reasonable rate. This one kind of talks about how you think about the application of these prongs towards the costs that are evaluated for inclusion in a revenue requirement, and focusing those on the cost of the company that are providing the service, not pulling in, holding company or other cost. So I think they work in tandem and a little bit on different facets of the capital returns.
Okay. Thank you. One more question, and then I see we've got someone else in the chat. On slide 17, sorry, I make you skip around so much here. But looking at the amount of investment that's needed, it does look like you have an opportunity here to issue additional debt and equities, and potentially the opportunity to, well, I guess if the issue here is, well, it's a double leverage issue, and it's the issue of incongruent capital structures at the holdco level and the operating company levels. Is this ability or I guess plan to issue additional debt and equities, is that an opportunity to do some rebalancing and get those capital structures in line? I know that probably works against any goals of utilizing double leverage, but if the issue is that we don't have capital structures in line and we've got different risk profiles among the different companies, is that an opportunity to get those capital structures in line?
Yeah, so I'll start and then I'll see if anybody here in the room wants to chime in. But from my perspective, I don't think there's any near-term intention with this financing plan to do any sort of rebalance or any sort of utilization of double leverage. I mean, this plan's really kind of built to be, the debt and the equity components that we're going to end up ultimately needing at the operating utilities to fund those operating utility investments. So we certainly have, as we talked about the three-prong test, we have the ability, and we do, consistently today issue debt at the operating utilities to support their service. When we issue equity or equity-like securities, that'll happen at the holding company, but we'll ultimately move that down to the operating companies as equity to support the capital structure necessary to meet those investment needs. But you might have just tapped me out, so I'll look at Jeff or Brian Buckler and see if they want to add anything to that.
Yeah, sure, Darren. I'll go ahead and jump in mechanically, and this will front run a little bit of my presentation, but mechanically, what you may see happen is we will issue equity at the parent, and that'll effectively, fund the dividends that are being paid at the parent. So you may not see that cash come down.
you've seen debt issued at the parent over time, but at no time have we sent any of those cash proceeds down to Evergy Kansas Central or Metro. So we have no concerns from a double leverage perspective as we look at this financing plan.
Okay. All right. Thank you. Well, I do see, I think Mr. Gorman, I know you wrote a chat that you were not able to raise your hand. Would you like to ask a question?
Yeah, actually, I have two questions. And Karen, I don't know if you're going to push this question off to another party, but the first one deals with Hope and Bluefield. As I understand that standard, it's a balance where the utility has to operate economic and efficiently in order to get those rate of return standards. And customers' rates must be just raised. Do you guys see managing your cost of capital consistent with that balance standard?
Yeah, so I'll take that, Mike. Thanks. Yeah, absolutely. And I think when you look at you look at our historical cost of capital and proposals, our operating company capital structures have consistently been in line with the peer utilities across the company. If anything, the provided equity returns in Kansas have been, below or certainly at the low end of the rate of return compared to the peers with which we compete for capital. So I think you could look across a pretty long horizon and see that we've been good stewards of ratepayer funds in provision of capital to investors.
Thank you. The second question deals with the standalone standard. Yeah, there is a separation in the parent company and the utility subsidiary capitalization mixes, but that separation isn't very clear from a credit rating standpoint. Typically, a utility's credit rating does reflect the consolidated leverage of the enterprise. Because of that interconnection, do you think it's important that the parent company and the utility subsidiaries capital structure and leverage risks be reasonably aligned?
Yeah, so I'm not going to go too deep into that now. I'm going to save that for a little bit later, and we'll let Todd Shipman kind of talk about some of that relationship. That's really why we've got him here today. But I would say, again, and we'll go through this in Brian's portion of the discussion. When you look at the information out there that shows talk about some of that relationship, that's really why we've
Sorry, we're getting feedback. Mr. Zakura, can you mute your microphone?
Yeah, is that
Thank you.
better?
Yep, go ahead. No, we're good.
Yeah. So I was just going to say, I mean, I think when you look at again, comparable across the country and across the holding companies in place, I mean, you do see a separation in capital structure and leverage between holding companies across the country and operating companies and their capital structures that they're rate made on. In fact, when you look at us, we don't have near the gap between the two as most of our peer holding companies. We pay strong attention to trying to make sure that we're being good stewards and that we're maintaining the credit ratings of all of our opcos as well as the holding company. But beyond that, I'm gonna let Todd talk to that in a few minutes.
Thank you. One final question. This was generated from Mr. Lay's comments, but yeah, to the extent the holding company does have more debt than the utility company, is it a fair characterization to observe that the primary cash flow available to the holding company are dividend payments from the utility to service that holding company debt?
Yes,
Jeff, you want to take that?
Sure. Yes, I would say that's correct. The dividends from the subsidiaries generally fund the shareholder dividend and any debt service that's needed up there. We do have some unregulated operations and other costs that are outside of the regulatory framework that are ultimately financed at that corporate level entity. And as I said, over time, as we see our investment level ramp up, we may have to reduce those subsidiary level dividends. So there will be some amount of kind of pre-financing our shareholder dividends based on those borrowings or equity issuances at the corporate parent.
Yeah. Thank you very much.
All right. Thank you, Mr. Gorman. Mr. Grady, I saw your hand for about a minute. Do you have a question or did it get answered?
I think my question got answered. My question was going to be on slide 17, and it was relative to the expectation for financing of the utilities with this new expanded capital expenditure profile that was recently released. And the question was going to be, is the expectation that that incremental debt will be issued at the operating utility level or the holding company? And I'm pretty sure, based on what I heard Darren and Jeff say, that the answer is that debt will be issued at the operating utility level.
Hey, Justin, I'll just clarify. I would agree that the vast majority of that will be issued at the operating utility. There may be a little bit at the holding company, but I would say greater than 80% of that debt will be raised at the operating utility level.
Okay, thank you. That's all I have, Chair.
All right. I don't see any hands and I'm not hearing anybody flagging me down. So, Mr. Ives, I think you were done, but I'll let you introduce your next speaker.
Yep, I am, and I'm going to turn it over to Jeff Lay, our Vice President of Corporate Planning and our Treasurer.
Great. Thanks, Darren. And thank you, Commissioners and Chair French, for having us today. Just wanted to reiterate that. I think this is my first time presenting for a lot of you, and it's a pleasure to meet you today.
Welcome.
I've spent about 18 years of my career in the corporate planning and treasury domain, which I think you can meet, which means I've spent a lot of my time thinking about this topic on capital structure and cost of capital. And as you can probably imagine, I have a long line of people out my door every day that want to talk that topic with me. But all kidding aside, it's something that I enjoy and I'm passionate about. And so I appreciate the opportunity to talk to you all today. One thing is we take a step back on capital structure, and this is meant to be foundational to the discussion because I know various of us have different experiences with it. I like to think about it in terms of how we might think about it in our personal lives, in terms of how we finance long-term assets. So much as we use a mortgage to finance our home and a blend of equity and down payment that goes into that, or same thing with a car. That's how utilities are ultimately financed. We blend a mix of long-term debt and equity to finance those long-term assets that serve customers for decades. And as Darren mentioned in his slide, as we talked about, we're showing about 7.3 billion of incremental long-term debt and equity coming over the next 5 years to finance the capital plans that we have before us. So as we move on to slide 21, there is a nuance though between how our personal assets are financed and how a company like a Evergy and its subsidiaries finance these assets. On the left side of the chart on the operating utility, it's much like our personal assets. We tend to use first mortgage bonds for our long-term debt. And in terms of equity, it's those retained earnings that we build up over time. But in times of high capital investments, we do have to supplement that with equity contributions from the parent to enable those higher levels of investment. The parent company on the right has several other mechanisms available to it. And it will use those from time to time. At Evergy, we've used unsecured bonds, and we have had a small common equity issuance in our history, but we may see some of these others come into the fray. Our peer utilities use all of these levers, and given the amount of capital investment that we're going to see across the industry in the years to come, we expect to see us and our peers access all of these different avenues of investment as we look to raise funds to finance the capital plans that are in front of us. Moving forward to the next slide, it's not just treasurers like me and finance nerds that think about capital structure and ROE. There's a lot of other constituents to who it matters, and I think that's why we've got a lot of the folks on the call here assembled today. For one, it's ultra important to our customers because we have the obligation to serve those customers and to provide them with competitive rates, but we also need to balance out maintaining a healthy utility. as we'll discuss at length in throughout this session, our investors, care a lot about this topic as well. And one of the groups that they look to for advice on it is the rating agencies, who provide them kind of a scorecard on how risky various investment alternatives are. And it extends all the way through our banks and vendors. Moving on to the next slide, I talked a little bit about rating agencies. And again, because I live in this world every day, I just wanted to kind of set the foundation for the language of rating agencies. And so we're on this chart, we show the ratings criteria for Moody's and S&P. They're really similar. There's a little nuance between them. You can see Moody's uses this, capital A, small a kind of nomenclature, whereas S&P would just uses capital letters. But other than that, they're pretty much the same. The thing I would highlight to you is that in the green area we have investment grade ratings, which is everything above a triple B minus rating. Below that, you have what's called non-investment grade ratings. A lot of times you might hear people call that speculative grade, and more colloquially, you might hear that called junk status. As you'll see later, our industry, strives to maintain an investment grade rating. And the benefit of an investment grade rating is access to capital markets. Capital markets have been extremely strong for the past few years now, but in times like COVID-19, great financial crisis, and several other periods that we've seen throughout time, capital market access does get disrupted. But investment grade issuers, whether that's debt or equity, do have more access to those capital markets over time. So the trend that you see in our industry and any other capital intensive industry like ours is to maintain a good, strong investment grade rating to ensure adequate access to those markets at all times. Moving to the next slide, I mentioned our peers, and so wanted to just give you a snapshot of how our peers are rated relative to us. You can see Evergy highlighted in yellow on the page. We do highlight in blue also the regional peers, but you can see that the Baa2 for Moody's and the triple B plus at S&P is kind of the median or average for the industry, and that's right where we've aimed the capital structures for Evergy. Want to be careful to note here, these are the ratings of the corporate parent. You can see ratings of debt issuances that occur at operating companies actually be notched up from this. They get rated higher, which again helps to ensure adequate access and also lower pricing. One thing that I didn't highlight on the previous page is you move up that scale in credit ratings, you also see a lower cost of debt over time and a lower cost of capital in general as you move up the scale with a higher credit rating. So the industry as a whole has coalesced around this idea, notion of maintaining strong investment grade ratings. Moving to the next slide, it is a balancing act though. We look here and we're really focused at the operating utility level here on the left and on the right in terms of long-term debt and equity. It's undeniable as a treasurer in wanting to maintain low cost of capital. I love to issue debt, but there's a limit at which I can do it. We look at our credit metrics and we have annual conversations and even more regular conversations at times with our credit rating agencies on maintaining that healthy balance sheet. And so there's a natural limit to how much debt that we can issue to bring through that low cost that ultimately benefits customers. Also, debt has that obligatory nature to it where you have to make interest payments versus with, on the other side with equity, there's an inherent flexibility there. We can curtail dividends or curtail dividend growth. Again, I'm mainly talking about the operating utility. At the holding company, dividends tend to be sacrosanct. We try not to ever, we would never cut those unless we were in extreme stress situation. And our investors expect that as part of their total return. So
Mr. Grady has his hand up. Sorry, Mr. Lay, I didn't mean to cut you off.
Sure. Justin.
Yeah, thanks, Jeff. Sorry to interrupt your flow here, but I guess I couldn't help myself. So on this slide, and I think you stated pretty succinctly that there's only so much debt that the utility can issue, right? Because those payments are compulsory and they have to be made on time. and they're definitely less subjected, or they have to be made, right? So, given that, I think a fair follow-up question is, if the consolidated entity can only issue so much debt, then why does there need to be a difference at all between the holding company and the operating utility capital structure, right? Why does Evergy need to have some of the debt at the holding company instead of just allowing all of it to exist at the operating utilities, so that the lower cost nature of that capital can be reflected in the revenue requirement process?
Yeah, and I think a big part of that answer, Justin, is that the credit rating agencies and the capital markets in general like to see a more robust equity layer at the operating utilities, given that is where the capital needs are most intensive. So, we need to access the debt markets pretty much on an annual basis for Evergy, Kansas Central, Metro, and our other jurisdictions. And so to maintain that access, we need a little bit more robust equity layer at that level of the organization.
Okay, thank you.
All right. I think I did. Oh yeah, go ahead.
Oh, sorry, Mr. Grady just kind of sparked a question for me. Um, it's something I've been mulling, and it gets to some of the heart of the issue. I think it's what you just said, that you need a thicker equity layer at the operating company level to, because you have a more, I guess, immediate need to access that capital. Um, but I guess the thing I'm struggling with is with a company like Evergy, where you essentially have it essentially owns three operating utilities, that all have almost the exact same profile. I know you've got a small sliver of unregulated business, but that's almost non-existent. But when your operating companies are essentially alter egos of the hold co, why why do they have a different equity need than the hold co if they're all essentially in the same business?
So some of that is timing, like we talked about. Our shareholders expect an annual dividend payment. Cutting that is very detrimental to a utility. So we do as at a holding company level, we do have to maintain that dividend and grow it over time. As we ramp up capital investments, like is shown in the 5-year plan that Darren shared in his slides, um, we are constrained by the amount of operating cash flow that's available at those individual utilities to finance that, and then therefore the debt that can be issued there and maintain those credit ratings. So the alternative is we can reduce the subsidiary dividends that come out of Kansas Central and Metro and go up there, and we can finance that with a mix of debt and equity. That's what our peers across the industry have been doing for decades now, and we're no exception in the plan that you see laid out there. So there really is no differential, but it's about flexibility of how you ultimately finance the capital structure.
Okay. I do see Mr. Gorman's got his hand raised now.
Appreciate it. Thank you. There's a need to balance the capital structure so you have adequate cash flows and earnings to support investment grade credit metrics. But then there's an ability or a potential concern that utilities can change the capital structure by increasing equity in order to increase cash flows and earnings, to allow them to invest, to fund larger rate base investments with internally generated cash. So where is the balance, and how does one go about reviewing whether or not the utility is balancing their capital structure to be no more expensive than necessary to maintain financial integrity, but to limit it such that it doesn't impose costs on ratepayers to increase internal funds available to fund rate-based growth?
Yeah, I think that there's two elements that we balance in that discussion that help guide us. One is, and Brian will go into this in more detail in his section. We look across the industry at how our peers are funded, and that gives us a pretty strong signal into where that balance exists. The other is that we do have that constant conversation with the rating agencies in terms of maintaining the financial flexibility and access to capital markets at the operating utilities and ensuring we have an adequate equity layer there to ensure that we'll have that over time.
Well, when you look across the industry in that manner, do you make it a determination of whether or not the peer utilities are giving adequate priority to affordable rates or competitive rate structures to customers?
We do look at our rates, and we see that our rates are regionally competitive. We've made great progress on that front over the past several years since the merger. And we do look at rates of others, and on a nationwide basis, I think we're doing an excellent job balancing that out.
Thank you.
All right, I think we kept you on this slide long enough, Mr. Lay. You can
No,
you can keep moving.
no problem. We'll move on to slide 26. And this is then just, and I think this is elementary for a lot of folks, but just in case other folks don't spend as much time in the weeds on this stuff as I do, just wanted to highlight where the equity capital structure and return on equity exists within the overall revenue requirement. It's in that return on rate base section. And as everybody has kind of noted in their question, obviously, all shareholders returns come from that equity component and that authorized return on equity. I mean, that's a part of why we care so much about it, but it does impact customer rates. And so that drives a lot of our focus here, but it is but one component of it. And on the next slide, we show a quantification of what that looks like based on, where our rates were coming out of the 2023 rate cases. And so you can see on that piece of the pie that's exploded out of the chart, that is the equity return component of our rates. It ranges 16 to 18% of the average customer rates in our region. And we see that as being, competitive with others in the industry. But it just highlights, for you to quantify, what that looks like. And on the next two pages, and I won't go through both pages, they're very similar. We just wanted to be transparent with the commission and with all the participants today in terms of acknowledging that an increase in capital structure and ROE does impact customer rates. And so this shows you the relative scale of that. But what we wanted to also provide you the visual on is that the increase in customer rates is also has an impact, and it could be an increase or decrease, right? This can go plus or minus. That there is an impact to ROE and to shareholder value that corresponds to that. And for the 1% or 0.1% change in capital structure or ROE that we show in these slides, you can see about a 0.2 increase in customer rates, but that almost a double impact, a little over double impact in terms of shareholder returns. So this is why this is critical to what we do on a day in, day out basis, and in every rate case or rate proceeding that we bring before these commissions. Regarding this, we try to strike that balance in terms of minimizing customer impact, make sure we're delivering good value for our customers, but at the same time, meet the needs of our shareholders. And with that, I'll go to slide 30 and here just kind of summarize my comments. Overall, utilities are capital intensive businesses and require ready access to capital markets to build and maintain the assets that serve our customers. We seek every day to try to strike that balance in our capital structure and ROE to ensure that we are able to access competitively priced capital across all the different levers in the market that are available while maintaining affordable rates. And the access to capital markets is greatest for investment grade companies like ourselves and peer utilities within our industry. And we're going to need those strong ratings over the years to come with the investment portfolio we see before us and the economic growth that's underlying that we want to make sure that we have the opportunity to have Kansas participate in.
All right, is that your final slide, Mr. Lay?
It is.
Congratulations. You made it to the end. We will pause to see if I think a lot of us got our questions out in the middle of your presentation, but let me just pause to see if any other hands go up. All right, I'm not seeing anything. Mr. Ives, I'm assuming you kind of know the pace of things. We've gotten through two presentations. We've got three more. Should we do one more and then take a short break, or would now be a better time for a break?
I'm looking over to Mr. Buckler, and he says full speed ahead, and,
Okay.
and then maybe we could take a break before we get to Todd and Dan, if that works for the commission.
Very good. Why don't you proceed then?
All righty.
Great. Thank you, Chair French, and thank you, Jeff and Darren, for going first. Good morning, everyone. Again, thank you, Chair French and commissioners and Deputy Director, all members of the KCC staff, and the many stakeholders who have joined us here today. My name is Brian Buckler. As mentioned earlier, I'm the new Chief Financial Officer of Evergy. We'll be moving my wife and daughter here next month. So looking forward to becoming a part of these communities here in the Kansas City area. Previous to this current role, I was the CFO at Oklahoma Gas and Electric for about 3.5 years. And prior to that, I spent about 15 years at Duke Energy wearing different financial hats, if you will, in Charlotte, North Carolina. With that, we'll jump into the materials. The next several slides compare the authorized ROEs and equity capital structures across the United States. These slides compare us in Kansas to the many other states and utility companies that we will compete against for capital over the next decade. On this slide 32, we're going to start with ROEs. In the orange bar, you can see that the average ROEs are coming in around 9.6 to 9.7% nationally. As the Deputy Director spoke to earlier, in our most recent Kansas rate case, we landed at about a 9.4 to a 9.5% ROE. That ROE range is right there with states such as Maine, Massachusetts, Washington, and Maryland, and roughly in the bottom half to bottom 1/3 of ROEs in the country. As I mentioned earlier, most of my career was spent at Duke Energy, which is represented by some of the states on the left, including Florida, North Carolina, and South Carolina. And those are states that have nuclear power plants in them. And as you can see, we've tried to highlight in the lighter blue bars across the slide those states where nuclear power is an important part of the energy mix. Turning to the next slide, we have zoomed in to highlight the average ROEs just for those states with nuclear operations. Certainly at Evergy, I've learned in my 6 weeks here that we are very proud to have the Wolf Creek nuclear power station. It provides our customers with around-the-clock, carbon-free and emission-free power. Its fuel costs are stable, and it's an asset that runs very well during extreme weather, such as a Winter Storm Uri. Yet being the owner and operator of a nuclear power plant, as I know from my Duke Energy days, it does come with tremendous risk. And with higher levels of risk, it often takes higher returns for investors to make capital infusions into your company. So in my opinion, that's why one of the reasons I believe you see the average ROEs for utilities with nuclear power stations at around 10% compared to that 9.7% we saw for all electric utilities. The next slide is really meant to be a pause point because I wanted to make sure we are clear as to why we're being so focused on peer companies, especially those with nuclear operations. And that goes back to the Hope and Bluefield principles, one of which is that a utility is entitled to a return similar to that being earned by other enterprises with similar risk. So we're going to keep on this peer comparison trend here for a few more slides. If we could move to slide 35, Pete, thank you. This is really part 2 of the comparables, this time related to equity capital structures. Again, we'll start with our latest Evergy Kansas Central rate case. We ended up at about 50 to 50.3%, as the Deputy Director mentioned earlier. That puts us to the right-hand side with states such as Maine, Connecticut, Illinois, Oregon, and Maryland. Again, roughly in that bottom half to bottom 1/3 of comparables. and certainly below the average of 51.2%. By looking at the left side of the slide, you can again find many of the states that have nuclear operations. For example, Georgia comes in at 56% equity percentage, North Carolina at 53%, and South Carolina and Minnesota at 52.5%. Okay, so now we're changing the group of companies or the level of those companies in which we're looking at. So this next slide is looking at equity ratios of consolidated entities. So the parent companies, if you will, of all the utility companies. The point of this slide is that the vast majority of companies shown carry very high levels of holding company debt, but not to a level that can hurt their investment grade ratings. And that's important. We'll go back to that slide 17 perhaps in a bit with any Q&A. But what happens with that holding company level is that you see the parent companies are carrying equity ratios that range, starting at 31% on the right-hand side, going up to some levels that are actually higher than utility codes. Evergy, as you can see, holds fairly modest levels of holding company debt. One thing I'll point to, instead of talking about the state levels, now we're talking about individual companies. So on the bottom of each of these bars are the ticker symbols, the 2 to 4 letter ticker symbols of all of our peer companies for which we compete for capital. So these are entities that are traded on the New York Stock Exchange and on NASDAQ. But again, these are companies we'll be competing against as we try to attract equity and debt capital to our company so we can build the right infrastructure for economic development in Kansas. The next slide, again, is a zoom in. So this is, again, our peer companies with nuclear operations. Each of those bars, again, is the consolidated holding company entity. As you can see here, every single one of these peer companies have equity ratios below the utility average, again, because they're holding significant levels of holding company debt. If you look at Evergy, we actually carry very modest levels of holding company debt on a relative basis compared to our peers. That's important. We've talked about the consolidated capital structure, that we do have utilities across multiple states. We do have, a small non-reg business, but that consolidated entity is financing for all those entities over a long-term period of time. And I know Jeff spoke to timing. We can go back to that in a bit. Perhaps what I would also like to point out is that I'm not aware of any of the holding company debt of any of these peer companies being imputed to the utility capital structure. Again, that's going back to kind of that Hope and Bluefield principle we talked about earlier, as far as similar returns for similar risk.
Brian, quick question on that.
Sure.
Have you looked at these different holdcos and sort of done I know we talked earlier about Evergy, essentially just owns 3 operating companies that are operating utilities. Have you done any sort of comparison with these other companies to see if their holdcos, have significantly different risk profiles or different business risk profiles? Do they hold different kinds of entities like merchant generation, things that might require a little different capital structure? And then if they do, I mean, have you done the further look to see, like, is there significant ring fencing to protect customers from those leveraged capital structures?
No, it's a great question, Chair French. We have not done detailed studies of all of these peers, so I'll be straight up on that. I can speak to my experience at other utility companies, of course, and then we monitor our peers very closely because we're competing with them for large customer loads, trying to bring in additional customers into our state, thinking about affordability, the way Jeff described, but also from a cost of capital perspective and the ability to attract future equity and capital. High level, most of our peer companies in the industry have exited their riskier businesses, such as merchant generation. For the most part, there's a couple of exceptions that still exist out there. The risk structure is pretty similar across, especially those with nuclear operations. I do think you find some entities that have more wildfire risk than we do out west, and so certainly that's a factor that comes into play. I see some of these entities have gone through acquisitions similar to Evergy, where they've they've used some holding company debt to make acquisitions happen. Typically, when those mergers happen, the utilities get a lot of efficiencies out of them. So I think that's why you'll see holding companies tend to use holding company debt to drive those efficiencies for their customers, because affordability is a big deal as you merge operations, as you know. So there's to your point, there are differences within each company. There's some companies that are very plain vanilla that only have one subsidiary, yet they do have holding company debt on top of them. So it's a wide range.
That's helpful. Thank you. I see Mr. Gatewood's got his hand raised.
Thank you. I'm curious, in the past 20 plus years, I haven't seen Evergy or its predecessors use nuclear risk in screening companies. They're preparing their ROR, ROE analyses. Has there been something that's changed in the past year in the industry that's shining a spotlight on nuclear as a preeminent risk and screening tool?
Thank you, Mr. Gatewood. That's a fair question. Obviously, we've owned Wolf Creek for a very long time. Maybe some of it is just my experience coming from a different perspective of being around other companies. Certainly, we've seen the rating agencies take a stronger risk lens on big events that can hurt a company's credit ratings. Wildfire risk being the most preeminent one of the last couple of years. So we took a kind of a fresh read through our S&P and Moody's documents, and nuclear risk is considered a key risk when you look at our company. And what's important to also remember is that many of our peers on this page, so Duke Energy, AEP, NextEra, Dominion, these are very large companies. Our market capitalization for equity is in that $14 billion area. Some of these entities have 80 billion, 90 billion, even over $100 billion worth of market cap. So on a relative basis, the risk, I think, is more pronounced the smaller your company is than the larger the company is. So maybe it's just us kind of stepping back and thinking big picture. What are the most appropriate peers to be looking at?
All right. I think you can keep moving forward. I don't hear any follow-up from Adam.
Okay, great. On the next slide, just two main points here. A lot of words, a lot of small words, but two main points. On the right-hand side, this is just recent trends since 2010 through 2020, 23. The top line, the green line, is showing utility capital structures, which have trended from around 50%, been pretty steady, but have gone up to about 52%. On the bottom is those holding companies of those same utilities, how you're seeing, again, more holding company debt, bringing down the equity ratio percentage down to around 44%. But what I really want to spend the time on is on the left-hand side, the blue bullet point that is highlighted. Coming into this exercise, I was not aware of any utility companies being burdened by regulatory order that imputed holding company debt into the utility cap structure. Now, that hasn't happened at Evergy either. So that's, to be fair, that's also important to point out. But knowing or that being part of my experience, we did ask an advisor to go through and do a detailed study of those holding companies that we compete against for capital. So they look at 29 holding companies. They reviewed 109 rate cases, and in no instance was holding company debt imputed into the utilities capital structure, which leads to our conclusion in that bottom bullet point that U.S. regulatory commissions do not rely on holding company capital structures when determining the appropriate rate-making capital structure.
All right. I see we've got another hand, Mr. Gorman.
All right, thank you. For this same time period, while the holding company debt has been increasing, the equity ratio decreasing, and the exact opposite has been happening at the utility subsidiaries. Isn't it also true that the credit rating of those utility subsidiaries have come under pressure because of the increase in debt at the holding company level?
It's a good question, Mr. Gorman. I'll we have Todd Shipman coming up right after the break, so I'll let him speak to a lot of that. I think what you're seeing, my opinion, the reason you're seeing utility credit ratings coming under pressure is because of the capital intensive nature of their businesses. And that intensity, I think, has grown as we're talking about inflation, as we're talking about an aging grid where you have distribution and transmission lines and poles that are becoming decades and decades old, and the need to protect those from a physical and cybersecurity perspective. And now we're talking about load growth that we haven't seen since the maybe 1970s and 1980s, and we're having to build out new generation like we haven't done in decades. And so I think when you have that level of capital intensity, that's what's really driving the pressure on utility credit ratings. That being said, we as an industry have an obligation. We as a management team for Evergy have an obligation to make sure we never let holding company debt get to such a level that it endangers the investment grade credit rating of our consolidated entity, nor does it impact the long-term debt cost of the utilities.
So you're not aware of whether or not increase in leverage at the holding company is at least in part attributable to any credit pressure the industry is going through right now, credit rating pressure?
Well, and maybe I'll point, if you'd like, I can either wait to answer that question more fully when Todd presents, or we can go ahead and ask Mr. Shipman to go ahead and unmute.
Let's hold that one for Mr. Shipman, if that's okay with you, Mr. Gorman. I think, and then maybe we could have Mr. Buckler and Mr. Shipman both weigh in. Is that all right, Mr. Gorman?
Yeah, that's fine. Thank you very much. Appreciate your time.
And I see Mr. Gatewood had his hand back up. Adam, did you have a question on this slide?
Just from Mr. Buckler's view, I mean, you see those lines begin to diverge, like 2014, 2015 time period. Just from a macro level, what does he see as a driver behind the change in the equity ratios of the two groups?
Yeah, and this is coming from my personal experience without having studied each of those 29 holding companies. But what I do believe has happened since say 2010 is that we're seeing the capital intensity at utility levels growing. So the capital 5-year capital plans and actual capital expenditures for utilities has grown at a level that we didn't see, I believe, in the 90s or even early 2000s. And what's happening there is that utility companies are having to use their free cash flow and their retained earnings, which is a part of their equity, to reinvest in the business. And so when they're reinvesting in business, that leaves less cash flows for them to dividend up to their holding companies. And then the holding companies who are trying to maintain long-term stock price strength so that when they need to issue equity, there's equity value there. They're maintaining their dividends. So the dividends that are being paid to shareholders are needed to keep that long-term equity value. But they're doing that with less cash flows coming up from their utility companies. And the way to make that work is by issuing some level of holding company debt. Now, they can only take that so far. I don't know if that 44%, it certainly can't go to 20%, but can it go to 42 or 41? We'll see over time. But all these companies are trying to solve for keeping really strong credit metrics, even at the holding company, so that the total cash flows, if you will, to keep the business running each year, including dividends to its shareholders, are maintained.
I see Mr. Campbell's got his hand up. Would you like to add something there?
I would, just echoing Brian's comments, and haven't looked at the 29 holding companies systematically, but I think that is a fundamental dynamic, has been a higher level of investment in regulated utilities. You've seen a real trend in that. I think the staff's done a terrific job. They analyze our plan every year and have noted how our capital plan has increased, but it's been increasing at a lower pace and level relative to what we're seeing in peers across the industry for some of the factors that Brian laid out. And I think the dynamic that's changed, at least now, and part of why we want to have the conversation now, is that with the backdrop of growth and real economic opportunity for Kansas, that the competitiveness of our framework of being an attract capital in a different environment where now we're working and really looking for opportunities to capitalize on growth was part of what we wanted to emphasize. Hey, the competitiveness is what we're really talking about, but the emphasis on affordability and balancing affordability and looking at our relative levels of investment relative to peers and comparing where we are relative to peers. We know how important that is because we know how important regional rate competitiveness is. So we know there's a balancing piece to this. We certainly don't want to ever imply that we do not. We just want to have that balance as we compete for what we hope is a terrific economic development opportunity for Kansas. Thank you.
Thanks. Mr. Grady, did you have a question on this slide? Or a follow-up to something you heard?
Yeah, a quick question / follow-up. So I'm looking at slide 36, sort of, 36 compared to 35 and 36 back and forth. And, my question pertains to utilities that are experiencing rapid economic development, do have significant capital expenditure growth, and yet do not need to have this difference between the capital structure of the holding company and the operating utility. And I was thinking about utilities that I know fit that bill, and one of them happens to be Oklahoma Gas and Electric. And Brian, I hope you don't consider this unfair for me to ask you the question, but given the fact that you just recently came from there, how is it that some utilities are able to navigate this environment, with all of its difficulties, and yet some utilities don't have this holding company structure that Evergy has?
Well, thanks, Mr. Grady. It's a good question. I would tell you the vast majority do. Number one, some companies had different lines of businesses historically. Oklahoma Gas and Electric had a midstream business for decades, and that poured in a lot of cash for many, many years that allowed them to pay that dividend without having to incur holding company debt. They did exit that midstream business in 2021, 2022. Had some significant proceeds that came in that allowed them to keep holding company debt very low. It's growing, and you can see that through their publicly available information. So they're kind of in line, I think, with everybody else on the page now, or will be over time.
Okay, thank you.
All right. I know we've rearranged your slides a little bit here, Mr. Buckler.
Yeah, I only have one more, Chair French.
Okay, very good. That makes it easy.
And there's a lot of words on this page, and I'm not going to read them. But I really want to just end with more of a statement. I think all we're suggesting today is that Evergy, Kansas utilities need an average ROE, an average cap structure as compared to other electric utilities in the United States. And we can debate whether that's ones with nuclear operations or not. But we need that, especially as we embark on capital investments needed to really drive economic expansion in Kansas, while keeping rates affordable for customers, as Mr. Campbell mentioned. So again, we're not asking for special treatment. That is not why we're here today. We're really here to ask so that we can be treated like other utilities on ROE and cap structure in a state that's very constructive, but that we're on the same playing field as we go into the next 5 years, where we're going to be issuing equity that we haven't done in many, many years. $2 billion of equity is a large number for our company, and it's probably going to grow. And the debt issuances will be making that mostly at the utility, but some at the holding company. We're going to need to be on that level playing field to keep our cost of capital low, and more than anything, to be able to access that capital to be able to deploy this infrastructure for economic development in the state.
Sorry, I'm on mute. Okay, we're going to pause for any additional questions. I see our General Counsel, KCC General Counsel Brian Fedotin has his hand raised.
Yeah, thank you, Chair French. I had a question on ROE and the ROE slide. In prior, or I guess there were several ROE slides, but 32. In prior commission orders, including orders on rate cases for Evergy, the commissions noted that an ROE of 9.5 in Kansas may not have the same effect of an ROE of 9.5 in another state, just because Kansas has certain other think riders and CWIP and those types of things that allow for basically enhanced recovery. And I'm wondering, is there any information that Evergy has that adds to slide 32 to give us a way to factor in all of those things? Because to me, slide 32 only tells part of the story. It doesn't factor in those other sources of return. Thank you.
I actually think that's a great question. We can certainly do more work on that front. Again, without having done an expansive study for each of these states to link that specific question that you just had, I can only speak from my own experience. Again, coming from Duke Energy, where Florida, North Carolina, you see on the far left, they both have multi-year rate plans, which is one of the best regulatory mechanisms you can have, kind of forward-looking and builds in, and that took over time. That's fairly recent legislation. Those ROEs have stayed stable and have even gone up. Those are states with, especially North Carolina and South Carolina, with tremendous economic development, bringing in businesses and residential growth. I can speak to a couple others, but it's a good question. We do believe the Kansas legislation that was passed in 2024 with plant and service accounting and CWIP and rates certainly helps with Kansas regulatory rating, as mentioned by Darren earlier. So that is a great step forward as the state leans into economic development. So wanted to give kudos to the state on that front, but there's definitely other states that continue to have more modernized, regulatory recovery mechanisms such as forward test years and those things, and they still are receiving ROEs and cap structures that are higher than Kansas.
Hey, Brian, it's Darren. I might just chime in for a second. Two things I think to consider when you look at that, and Brian hit it well, but we all assess that and evaluate that when we come in for a case, and certainly that's part of staff's position in the case. You'll see our witness Ann Bulkley does an analysis of risk weightings across peer utilities that are evaluated in her ROE assessment, and I think her analysis would say we are not necessarily any less risky than kind of that at least the middle of that group of peers when she does that assessment. The other place I'd point you to is that's part of the assessment that the credit rating agencies and also the the RA analysis that I alluded to earlier on takes into account when they're looking at constructiveness of jurisdictions is the mechanisms and the recovery methods that are available. And I think those all say that Kansas is still at the middle level or maybe a little below the middle level on constructiveness for investor returns. So we do look at it and certainly look at it across a lot of fronts, and it's not reflected on this chart, but certainly does get reflected in the case. And I'd be remiss if I didn't echo Brian's point and say the state's move on House Bill 2527 was a fantastic step, and that work didn't get done without the involvement and the consideration of the commission, the staff of the commission, and the stakeholders that are on this call. It wasn't just the legislative building, it was all this group that sat down and worked through that. So everybody here contributed to that very positive outcome and movement in treatment in Kansas.
Thanks, Darren. And actually, let me just this slide. I've always struggled with this slide. I know this slide in particular is trying to actually. I think it's trying to show sort of a risk premium associated with nuclear operations. But if you take that away, it's just a comparison of states, and I've always struggled with that because of that issue. You say you don't know what treatments are involved in each state, what the reasons are behind ROEs. what they're trying to incentivize. I know people talk about FERC candy. What candy different states are handing out. But one question I've always had, just kind of back to ROE theory, is you're trying to simulate, at least the way I was always taught it, you're trying to simulate the required return to induce investment. And so to me, there is a range that we try to get through our models. But it is, the required return is the minimum that's required, or the lowest cost that's required to induce investment. And so when you look at these ranges, I mean, are there utilities in here that are unable to induce investment? Does investment just come more slowly? I mean, how does that show up as it goes lower? I mean, does it have to get into the, you know, 4% range? Do you have to merge with debt before you're unable to capitalize your business with equity? I mean, what is what's the practical effect as you go down? Because I mean, I would observe that pretty much all of these utilities are being, they all have equity. So, what's the day-to-day impact there?
Yeah, so I'll start, and then I think Jeff and Brian can chime in, but a couple things I think, right? I mean, I think when you look at this range of the ROEs where you started, right? And you think about how we evaluate it in a case. I mean, I think that's part of the process we go through, right? It's not just looking, I'll say carte blanche at, kind of ROEs across the country, but the folks that testify in the case, they establish proxy groups that are intended to be, as comparable and equivalent to the operations of Evergy as can be assessed in a kind of an industry search, right? So they exclude those that are outliers, or have more non-regulated operations, or maybe are in the midst of transaction, or other things that can skew the results of that. Attempting to get to apples as you can, and part of that assessment is kind of risk profile of the operations, and how those are looked at from credit rating agencies and RA and others. So you get that prong, and then I think there's certainly a range of outcomes that come from Hope and Bluefield, and we could probably debate for a while, and it's probably not worthwhile today, right? Whether you should get to the minimum that's required to induce investment. I mean, I would say when you look at Hope Bluefield, it suggests that you should be getting to something that's providing a comparable return to comparable risk-based organizations. So that might not be the minimum if the comparable risk organizations are coming in at closer to the midpoint of what's going on across the country. So I think that could be, real facts and circumstances as you go through there.
Yeah, that's fair. I mean, I know using the word minimum was provocative. I guess I was trying to say that, we're trying to simulate the required, which may be the minimum, but to get that, you're trying to find commensurate risk within those tools. So you do end up with a range. So yeah, it's how you look at that.
Yep. No, super fair. And then I know these guys are going to want to talk for a minute. I would say, there are some people that recently have, had more access issues than maybe historically. I mean, I think there's some utilities in Connecticut that have faced some of that. I think, Ameren certainly has had some issues in their Illinois utility after, some recent decisions over there that were fairly unfavorable for investors. And I might just open it up and see if Brian or Jeff have any additional specifics they want to add to that.
David, you unmuted. I don't know if you want to cover something.
Well, it's really just going to echo Darren's point. I know we're always thoughtful about talking about other utilities and being respectful of those dynamics, but I think we are in an environment where I think Kansas has a terrific opportunity to take advantage of growth opportunities, and that will require some investment. So we are, in that sense, competing for capital. And there definitely have been some examples of states in the far right of where capital investment has been reduced, and parts of that's some pretty strong feedback from equity investors on that front. Now you could say those are extremes. Can we find balance? I think what we're driving for is saying we know how important affordability is and regional rate competitiveness, but we also think it's important to be able to access capital and make the investments to take advantage of the opportunities we have. So trying to get that balance so that Kansas is well positioned to get the investment that we think will really benefit the broader state. So that's because I think there can be consequences, and we just are looking for being competitive to take advantage of a great opportunity. That's how I describe it.
No, that's really helpful from all of you. I think, I understand the sensitivity to not call out anybody specific, but it does help to have concrete examples. I don't think I'm making a provocative statement at all to say, the KCC is committed to making sure our utilities have very firm financial integrity and are able to access the capital markets on favorable terms. And, of course, we can debate these things around the edges, but we never want to jeopardize that. So I don't think that's a controversial statement at all within the KCC. So I do see Mr. Gorman has raised his hand.
Yeah, thank you. I appreciate the complexities, but there's a lot of dynamics at work here. You mentioned Ameren in Illinois. They had one of the fastest rate-based growth periods of any utility in the country, despite the fact they have one amongst the lowest returns on equity. And more recently, some of the concerns they have for rate making credit rating stability is the fact that they didn't provide a grid plan to the commission that met.
Mr. Gorman, your audio is just going in and out a little bit. I don't know if you just need to maybe stay closer to your microphone. I'm not sure what's going on, but you're going in and out just a little bit.
Yeah, can you hear me better now? Okay, just an observation on Ameren, Illinois, since it was mentioned, that it has had the lowest return on equity across the country, but yet it's had the fastest rate-based growth and relatively stable credit outlooks until more recently, when the commission rejected a grid plan filed by that utility as not meeting the new state law. So are those complexities something you consider in determining what a fair ROE would be that would support financial integrity and the ability to make necessary infrastructure investments to serve customers?
Yeah, so I would just say, and we don't need to debate Ameren, Illinois, but there are a lot of complexities, right? When you try and compare across states with different recovery mechanisms and formula rates and other things that aren't applicable in our state versus another. And the whole point of that discussion was to highlight a response to the question to say that recently there have been some concerns from a couple utilities or a few in the country on access to capital, kind of based upon equity investor feedback as a result of regulatory decisions that have not been beneficial to continued investment in those states, and that was the sole point of that discussion.
All right. Mr. Gorman, I see your hand still up, but I assume that was just from the last question. All right, hand is down. Mr. Buckler, I think we got through the end of your slides, and I'm not seeing any more hands at this point. Did you
right,
have
Chair
any?
French. That
Yeah,
was
did
my
you have
last
anything
slide.
further? Okay,
No,
very
no,
good.
sir.
All
Thank
right,
you.
well, let's plan to take, it's a good stopping point. Let's plan to take a 10-minute break. Everybody can go refill their coffee cup. We will be back at 11 o'clock a.m. and we'll start with the next presentation at that time.
Thank you.
All right, Michelle, I've got 11 o'clock. Okay, we got our slide down. I think we are ready to proceed. So, Mr. Ives, I'll let you introduce our next speaker.
Thank you, Chair. We're going to hand it over to Todd Shipman. Todd currently works with Concentric, but he has a long background with S&P and across the industry in general. And I'll let him, give his background and introduce himself.
All right, thank you. Welcome, Mr. Shipman. Your name's already been mentioned a few times, so
There you go.
I hope you took
Mostly
some
in vain.
notes.
There we go. Yeah, no, I look forward to it because I think while getting to it, as I introduce myself, so if you can go to the next slide, just by way of background, it is almost 40 years getting there. Next year would be 40 when I started and in this industry. And I think one of the more important things is that I've been doing this, looking at regulators right from the start. I started at RRA, which has also been mentioned quite a number of times today, and then later at S&P. But I've been following regulators and regulatory behavior, man and boy, for almost 40 years. And here we are. And a lot of these topics that we're talking about today, we were talking about 40 years ago and probably 40 years before that and things like that. The other thing I would just point out on this slide, in addition to being an expert on the criteria that was used by S&P, I wrote most of it and was involved in a lot of other things criteria-wise at S&P. So I welcome, questions because criteria is by nature somewhat esoteric and whatnot, and it's sometimes misinterpreted or just misunderstood. So I'm happy to clarify things for folks. And then just on the last slide, I've been doing this for 6 years now or so, and this kind of environment, this kind of proceeding is exactly what I was thinking I was getting into. It's been few and far between, but I do relish the opportunity to have dialogue and talk outside of the more stilted rate case type of environment. So you can go to the next slide, please. I think everybody here would probably agree with this, but I will spend a little bit of time just to emphasize for everybody one of the reasons why Evergy invited me to come here and give an independent view to help encourage this dialogue is that ratings are important. They are, especially for utilities, but all across corporate America, ratings are important. They are used primarily, to price risk by debt investors, decide what price that they will charge to lend money to entities like Evergy. But they're also used by equity investors, which I hope Dan will agree with me, as a kind of a proxy for general risk, even though it's very focused on, credit risk. It's also a pretty good proxy for the overall risk of an enterprise. And other entities such as trade creditors and things like that. People do consult them. I glossed over the third bullet, but it's especially important for this context. I think has a direct impact on the rates that customers that you regulate on behalf of pay for their electricity and gas. And so it is important in that case, as well as the broader implications of credit ratings. It has a very direct effect on what customers pay. Next slide, please. This is something I like to bring up in testimony all the time, and it's kind of a pit for regulators to use the ratings in particular and the rating agencies in general as a resource when they're trying to and I know the commissioners on the call here was certainly preaching to the choir, but almost everybody that comes before you has a point of view. In Wall Street speak, that's called talking your book. And but I think credit rating agencies are somewhat unique in the whole world of finance, in the sense that they're looking at the big picture, looking at credit and risk in general. They have a long-term point of view, which, again, in the context of rate cases and other proceedings and stuff, it's easy to get kind of overly focused on the minutia and the short-term kind of considerations that go into decisions. But credit raters have a much more long-term perspective, in part because the debt is often long-term in the utility world, up to 30 years, sometimes more, but not too much more. But it's not just a daily thing or even an annual time frame that they're concerned about. It's long-term in nature, and I'll get more into that. And they are independent. They really don't care what the rating of Evergy is. They care about getting it right, and all, but they don't care about whether it's investment grade or non-investment grade. If it's called for, they don't care about whether it's going up or going down. They're trying to make the call. And so again, a pitch to the especially the regulators in the call here. It's a useful guide for you, I think, in my opinion, to help you make your decision. So I put this slide up here because it's a little involved and all, but I'm going to use this as an opportunity to give some history, or really what I call evolution here, about ratings and how utilities were rated. This is an S&P. I didn't do a good job of identifying this, but this is the depiction of the S&P credit analysis to help people understand how it's done. And this is applied to utilities as well as the rest of the corporate rating universe and all. But it's been through a lot of changes, and I think those changes would be instructive for everybody on the call about, especially as you get to the right-hand side of this slide. When I first joined S&P in the early 90s, the utility group had their own criteria. And for lack of a better way of putting it, they basically went about their business any which way they pleased, so to speak. And utilities are quite different from the rest of corporate ratings, mostly because of people like the chair and the rest of the commissioners here, the comprehensive regulation that marks utility credit profile is quite different from the rest of ratings. So at the time, it was considered to be a perfectly natural or appropriate thing to do, to let us kind of go on our own. And at that point, we were a little inside baseball, but we were pretty much able to ignore holding companies and things like that, and rate utilities on their own. And then fairly shortly after I joined, so this is probably 95 or so, we got a new leader of the whole bigger group, who was not a utility person. And he said, no, wait a second. You can't do it this way. You have to fit into the whole corporate rating framework at S&P. And I'm going through S&P, frankly, Moody's, even though they're the #2 rating agency, they had this right, so to speak, from the beginning, in terms of looking at the utility as the main, kind of source of everything and the main focus of the credit analysis. So this new person came along and said, no, you have to fit into this whole framework that we rate everybody else at S&P by, or every other corporate entity. And that's when the whole prospect of, well, what's the holding company? Who's the ultimate parent? Started to become, well, not only became more important, in my opinion, a little bit of my own view of things as mostly a utility person in the whole thing. The pendulum kind of shifted almost all the way to the other side, so that all we really looked at was the bigger picture and the details on the utility subsidiary got a little lost, not completely lost, but a little lost in the whole thing. At some point, and it was, well, it wasn't at some point, it was in about 2013, the whole criteria was revamped in a very, very big way in response to the 08, 09 crisis and the higher scrutiny that rating agencies were enduring at that point. And as a result of that, this, I think, maybe, yeah, if we can go to the next slide, since I'm boring everybody with the slide too much. This whole concept of the standalone credit profile became more prominent in the whole thing. And now, you know, the knock on utilities or knock on rating agencies before this is that was a little black box. It wasn't very transparent about how we went about doing our business. And that was part of the 2013 update. Everything would make it more clear to investors and other people who use ratings to see how the sausage was made, so to speak. And the standalone credit profile concept, I think, had been around since 2010 or so, but was not really paid attention to tell you the truth. But because of this, it became more apparent. And one of the reasons was that the investors, since that pendulum had shifted so far to really, in my opinion, overestimating the impact of the parent on everything, we got a lot of feedback from investors, the utility investors, who really wanted S&P to focus, like Moody's, more on the individual utility credit profile and part of the whole thing. And so now, and since this whole revamp, S&P in its credit analysis and in its credit report is very explicit about the standalone credit profile of each of the utilities that it rates. And that is because, in my experience, utility investors look just as much, if not more, at the standalone credit profile than at the final rating. It's quite different from the rest of corporate America, which frankly doesn't fund at the subsidiary level anyway. But it is something that, and I think it's relevant to here, and I'm sure I'll get questions on it, which I forgot to note at the beginning, that please raise your hand at any time, anybody on the call, because I'm happy to be interrupted. But there we go.
Ask and you shall receive. Mr.
There we
Grady's got a question.
Absolutely.
Yeah, thank you. Thanks, Chair. Todd, good to see you again. Hey, I've got a quick question relative to this, that's Evergy specific. And, I haven't seen anything pertaining to S&P's ratings on Evergy at the holding company or at the operating utility level since the last rate case, full disclosure. But in the last case, actually one of the arguments that we used in support of our position in that docket was that S&P rated the holding company and the operating utilities the exact same, right? The group or government influence modifier or factor was so significant that despite the fact that the operating utilities had, substantially better financial metrics and cash flow to operations or FFO to debt metrics, that the existence of that holding company debt, S&P found that so significant that essentially they had the exact same rating. There was no notching, in other words, as Jeff Lay mentioned before. So I guess I'd just ask you if you know whether that rating is still the same, given your experience at S&P, if there's anything that you find, that you wanted to reference there or discuss.
Thank you for the question, Justin, and good to see you, as always. Off the top of my head, I probably couldn't recite it. Jeff is next to me and he'll correct me if I'm wrong, but I believe there's some ratings that are above what they call GCP, the group credit profile, in S&P speak, and but most, if not, maybe all, are at that level. So that's the rating. The SACPs are diverge not too much from the holding company, if memory serves, but they're all around the same level. But there is some differences, and in general, in the way S&P rates things, and any credit rating agency, frankly, even though there's some different emphases from agency to agency, they always care about who the ultimate owner is and who is controlling things, and so it always has it's always brought into the credit analysis, but its impact is can vary quite a bit from company to company, depending on a lot of different factors and a lot of different circumstances and things like that. And so I think they're sort of not all over I think they're all over the park on SACPs, but the ratings, except for I believe one exception, the ratings are all the same. Yeah, that issuer credit rating, just to be clear, and the SACPs differ.
Yeah, Todd, this is Jeff. I'll just weigh in. Like you said, the issuer credit ratings are all the same, but as you look at those standalone credit profiles that Todd was talking about, you do see differentiation between the different entities. I think we maybe even in the course of last year's case, I think through a DR, through some other question that maybe came through Darren in the regulatory group, there was an ask on why the issue, on our actual debt issuances, our senior secured ratings were a little higher at Metro than they were at EKC, and that's emblematic of that. I think another thing that I would point you to, shifting away from S&P, looking at Moody's, as Todd mentioned, they do look at that, at a bottoms up level for each entity individually. There is a group influence that they still factor over the top, but a strong indicator that I would tell you about, it's not something that as a treasurer I'm happy about, but at Missouri West right now, we are on a negative outlook, but it is only at Missouri West. It does not, it doesn't impact Evergy Inc., Evergy Metro, or Evergy Kansas Central. And so I think that does show that there is a loose affiliation with those credit metrics that can sometimes be one-off.
Okay, thank you.
And I see Mr. Gorman's got his hand up. Go ahead, Mike.
I appreciate it, Todd. Can you describe certain ring fence separations that can create more of a distinction in the credit rating of the utility versus that of its parent company? Such as restrictions of movement of cash from the utility to the parent company, or even separate board of directors at the utility versus the parent company.
Yeah, if I get into too much detail, let me know. It'll end up on the midterm if I give you too much. But that's very complicated. It seems like I spent half my time talking to companies about these things during mergers and things like that. But I think the simplest way to summarize the S&P approach to those questions is that there is an opinion really based on a lot of the historical record, that utilities are independent by nature, again, because of the regulators, among other things. And so there's you mentioned ring fencing. I don't like that term. It's a very, very specific term of art having to do with structured finance. But I like to use insulation, but really it's about how much independence there is, but there can be structural and legal things that you can do to create more space between them, and it's very involved. But I'll say that as a general rule, restrictions or potential restrictions of cash moving between entities is probably the thing that is the most impactful on that analysis.
Thank you.
All right.
All right. I
And if I,
don't see any more hands, so go ahead.
all right, and if you go back a slide, I I uh I forgot what I wanted to use this slide at the very right hand, or almost the very right hand, the little slider there, that group influence group rating methodology is what it's called in S&P speak, and that's where the parent, the impact, the effect of the parent on the rating is analyzed. And I know it came up, and so I guess I'm anticipating questions. It came up there earlier. I got a sense that there's curiosity about why is there holding company debt? Why does it have to exist, so to speak? Well, it doesn't have to exist, but why is it employed? And in addition to some of the good answers that the Evergy folks gave, from my perspective, from a credit rating perspective, it's actually a good thing in two ways. One, the holding companies are really, with in the case of multi-utility holding companies, the sum of the parts is actually greater than the individual parts. I think, Chair French, you mentioned, that Evergy just, three holding companies or three utilities, and then that just make the holding company the same as those three put together. But it is, from a credit standpoint, actually kind of a case where 1 + 1 + 1 actually equals more than three. And again, that gets into a lot of intricate, things in the credit analysis. But as a basic, overriding term, or factor in the credit analysis, size and diversity are very useful to how to manage and minimize risk. And so it is a case where there's regulatory diversity, operating diversity across a number of different utilities and a number of different jurisdictions. And the utility holding company is, by nature, just bigger than any of the pieces. They actually have some, what the investment bankers call debt capacity at the holding company level, without really affecting the credit rating, so to speak. And sometimes they're about the same. Sometimes maybe one notch less for a variety of reasons. But they actually can, in a cost-free way, add debt at that holding company level without having a major impact on the overall credit profile. Sometimes it does, but a lot of times it does not. And the other thing I would say, from a credit standpoint, the usefulness of the holding company debt involves a concept in credit analysis called financial flexibility. And without getting into too much there, basically the fact that the holding company has a capital market presence, not just in the equity market, but also with hybrids and with actual debt, is considered to be a good thing from a credit standpoint, because if they're under stress, there's another avenue for accessing capital that, if they didn't do it before and they were trying to introduce themselves to the capital market stress during the time when they're under stress, it would actually be detrimental to the whole thing. And so there's actually, from a finance standpoint, it's actually a very useful role for holding company debt to play. And it's not just a matter of adding leverage for leverage sake. Let's go to I guess we're 2 slides on now, please. Now we get to finally getting down to the reason we're here. There's several things I would point out on this slide, but I don't need to, because they're on there. One thing I would emphasize is the capitalized terms, their financial risk and business risk. If you can think back to the pictorial depiction of the credit rating process, it's basically a two-part. You have the business risk, the qualitative side of credit analysis, and then you have financial risk, which is the quantitative side, the metrics and things like that. And I can't overemphasize the role that regulation and regulatory decisions and behavior plays in a utility rating. And it in part is because it acts actually on both sides. The business risk, which I'll get to, I think, in the next slide, is for the most part regulatory risk. There's other things that come into it, operating risk, as you might imagine, how well the system is cared for and operated and things like that. But it's a big part. Regulation is a big part of the business risk. But obviously, because of decisions on things like capital structure and ROE, among other things in rate cases, the ability of a utility to generate cash flow, which is what financial risk is mostly about in the credit rating world, and it's really constrained quite a bit about what the level of rates are and what the regulator does in terms of how costs are recovered and things like that. And the other major thing I would say on this slide that I would like to point out is what I call the signaling effect. And this kind of gets into practicalities of a credit analyst sitting at his desk or her desk, and you're trying to rate probably up to 20 different entities or something at a time, and they don't always have time, believe it or not, to read all those wise decisions that you make. So a lot of times they use ROE and capital structure as kind of a shorthand way of assessing regulatory risk. More goes into it. I think David or somebody mentioned that. They look at details about how, like this Darren, the rate structure and rate design and things like that. They do look at that, but as a shorthand way, they often look at not just at the direct impact that decisions on capital structure and ROE have, but also what the regulator is trying to signal to investors about the desire that they have to allow a utility to access capital and invest in the state on reasonable terms and have access to capital. Everybody's talking about access to capital, but credit raters by nature are kind of the glass half empty type folks and not the glass half full kind of folks. And they're looking at capital access, not just when the sky is shining and the birds are singing, but when times are tough. And that's one of the reasons why that long-term focus is so important in credit rating, is because they want to be sure if they're giving investment grade assigning investment grade ratings that's pretty durable in a lot of different capital market and economic scenarios. And that's a big part of being investment grade. And then again, the final point there is this really has a big impact on cost of capital, these two items, and it is long lasting, much more long lasting than any given rate case or anything like that. It'll affect the cost of capital, especially cost of debt, but both sides of it for a very long time. Okay. We'll skip the interlude. The next slide. I was reading the Wall Street Journal one morning on the train and saw that cartoon. So I've been waiting 30 some odd years to use it. So I finally got to.
I've got one question sort of on those previous slides, Mr. Shipman. If you go back, I don't know if it's on this one or the one before, but yeah, probably. Well, it was back when you were talking about the reasons why it's good, for the holding company to be able to issue some extra debt. And I think, I think you've got me convinced. It's a good thing to have that access to debt there, to be able to get some cushion. I think the question and where I get tied up is, for whose benefit that capital structure should be held. I mean, when you have a holding company whose only business is and sources of revenue are operating utilities. I guess I'm still struggling with, and I think everybody's struggling with that question of like, why is that that capital structure, which only exists to fund utility operations, why is that not, why should it be held separately or viewed separately, or why does a rating agency care if it's viewed separately from the operating utilities?
Well, short answer, the rating agencies or credit rating analyst cares very much about where the debt is that he or she is rating as well. So that gets into, again, some pretty esoteric things about structural subordination and things like that.
Oh, we're already into the esoteric
And
things, I think.
Oh, okay, that's not okay. Yeah, I shouldn't underestimate the financial acumen of the folks on this call. It is very high, and so yeah, so it does matter, and it's in credit rating terms, it's called like a waterfall, so to speak, where but where the debt is in the whole structure really matters in the rating that is assigned and things like that, and so the utility debt is closer to the assets, so it's the higher quality debt, and that debt gets taken care of, serviced, and paid off or refunded before cash goes anywhere else in the whole scheme of things. And so the fact that there's debt elsewhere, in a sense, sometimes higher up in the whole hierarchy, will affect that debt, but not necessarily the debt at the lower, that's closer to assets, because that's the debt that holds the most value to investors. They know what creating the cash flow that will provide them with their interest payments twice a year and will get them their money back when they want it back.
Does the amount of insulation between those, a holdco and its operating companies matter, or are those debt holders looking at it so simplistically that they just don't care? They just want to see the level that it's at.
If I understand the question right, I think it's the latter. I think, because they're first in line, especially first mortgage bond holders, we mentioned before, they're first in line for a variety of reasons. They really don't care about who has to has to be taken care of after that, and especially on the equity side, with all due respect to Dan Ford here. Equity, they're useful. They provide a cushion for debt investors, and they appreciate that role that the equity investors take. But it's really a matter of that waterfall I was talking about. I think from the context of your question, insulation is can matter, but it really matters more to the folks that are second or third in line. If there's some restriction, especially if there's some restriction on how the cash gets to their level.
I think that answers my question. I see Mr. Fedotin has his hand raised.
Yeah, thank you, Chair French. My question relates to the last two slides, including the cartoon that you had, and it's on ROE. If my understanding is correct, utilities often don't come close to their authorized ROE. So I've never understood why the market cares what the authorized ROE is rather than what the actual ROE is. And I didn't know if that was just kind of, as this slide shows, it's just a shorthand for how friendly the regulator is, or what. But I'm curious to get somebody who thinks more like the market rather than me as a regulator to weigh in on that. And I don't know if you're the right person, Mr. Shipman, but so.
Absolutely. No, I am, because of my RRA background and all that. I've been doing this for 40 years, and to give you some historical perspective, it's not always the case that utilities either barely earn or under earn their return. It happens especially during inflationary periods, as you might imagine, and all that. But it's not. It doesn't have to be that way, and especially as everybody went through earlier in the day about the growth opportunities, which is, it's quite extraordinary from an historical standpoint. Growth cures a lot of ills on the financial side and on the credit rating side. And so I remember Tampa Electric. I followed them. They had to file a rate case when I was following them, and they hadn't done so for 20 years. They didn't have anybody around that knew how to do it. They had to try to figure it out. So they went 20 years with, I'm sure, because of growth there and all, without having to file a rate case, which meant they were either earning, what the current kind of return was, or probably over earning quite a bit because of the growth and at times. And so it doesn't always matter. But I would say, without challenging your premise too much, a fundamental way of evaluating a regulatory decision on rate is what's the ROE and can the company have a fair opportunity to earn it, understanding that the future is going to hold a lot of risk in terms of the economic conditions and all that.
Right. I guess I've just always been confused that if the ROE is set at 9.5 and the utility is earning an effective ROE of 7, why the market cares that it's 9.5 versus 10 versus 9. And because it seems like I've witnessed that from my seat.
Well, that's certainly the starting point. I think that's why it's important. It has a big impact on what they eventually will be able to earn.
Hey, just real quick, Brian. I mean, I think this will be helpful, but there's a certain amount of regulatory lag that exists, jurisdiction to jurisdiction, right? Based on the surcharges and the other mechanisms to mitigate that regulatory lag. But if you assume that regulatory lag with a certain growth profile and a certain capital expenditure growth profile knocks off, say, 200 basis points off from the difference between your earned ROE and your authorized ROE. Well, then the higher the authorized ROE goes, the higher the earned ROE goes. And the lower the authorized ROE goes, the lower the earned ROE goes. And so there's definitely a relationship there, right? If the authorized ROE is turned into revenue, it's revenue that the company recovers from customers. And then at that point, it's up to the utility to manage it in order to have an opportunity to earn a higher ROE. You can't earn a higher ROE, all other things being equal, unless the authorized ROE is higher, right?
Right.
Important thing there, all other things being equal. And before I take Michael's question, I think it would be helpful to go to slide 56, really more or less at the end of everything. And then this is exactly how a credit analyst looks at the whole thing, and I think it goes through on this thing. So both things are important. In the end, the ability to earn a reasonable return is the kind of the hallmark of what is called constructive regulation in Wall Street terms. But both of them are, I think, important. And with that, I'll go to the next slide, and just that's the end of the whole thing. If you had any questions about some of the previous slides, I'm happy to do it. But just going through everything here, I'll wrap up and take Michael's question, and then I'll exit.
Okay. So you're at the conclusion of your presentation. Is that what you're?
Yeah, I think at this
okay.
point, I think all the other stuff. Yeah, if you had any other questions now or in the future,
Right.
please reach out and about
right.
anything else. But all the other stuff is pretty much.
Well, I do see some hands now. Mr. Gorman's had his hand up for a while, so we'll go to him first, and then Commissioner Keen's got his hand up. We'll go to him next.
Okay, quickly, Todd, how does a credit analyst view the discipline of the market the utility operates in assessing just what the business risk and the regulatory risk is to the utility, or whether or not the utility management simply isn't responding to the price signals approved by the regulatory commission? recognizing that regulation is a surrogate for competition. In a competitive market, management has to respond to market pricing and adjust cost structures to profitably operate in that market. If a regulatory commission decides a utility's management's preferred capital structure is more expensive than necessary to maintain financial integrity for utility operations, and it sets rates based on what it believes to be a reasonable capital structure, do, do credit analysts expect management to respond to that and adjust actual cost to align with what the regulatory commission finds to be reasonable cost?
Short answer is absolutely. Management is a big part of business risk profile analysis, and how they manage regulatory risk and how they respond to regulatory decisions is absolutely a big part of the final answer in credit analysis. So I would absolutely agree that it's not, I put a lot of emphasis on regulatory decisions and how much impact they have, but frankly, in the end, the credit rating agencies are holding the company's feet to the fire to deal with whatever they have to deal with on that side in order to achieve whatever the expectations are to maintain that credit rating that they're at.
Hey, Mike, it's Darren. I think that's a little bit of the discussion we were having earlier, right? When we talked about a couple of the states that maybe have changed their investment trajectory as a result of regulatory decisions, right? That's exactly what credit rating agencies and our investors would expect us to do, right? I mean, follow the direction of the results of the regulatory order, and align our investment strategy accordingly. And if our commission, one of our commissions, indicated that we needed to reduce our level of investment because of the way they were providing recovery, that'd be incumbent upon us to react to that, or face the backlash from our investors.
Thank you. That's exactly what that last bullet on that slide is exactly. But you said it much more eloquently than me. But yeah, we expect the rating agency expect management to manage, and that's a big part of the final answer. As I said, I think Commissioner Keene is next.
Yes, go ahead, Commissioner Keene.
Yes, indeed. Mr. Shipman, first of all, thank you so much for being a part of this informational undertaking. I find virtually the entirety of your presentation to be really pretty results oriented and very helpful. So let me kind of ask a manage by exception question to you, if I could. Given your experience, which is incredibly diverse and impressive, and from your perspective, what are the pitfalls, if you will, or cautionary notes that you could provide when persons use rating agency analysis and reports to make comparisons from one utility to another and from one state to another?
Thank you for the question. You're saying what would my advice be if people are in a sense misusing the information or not really getting it?
No, not really misusing it.
Oh.
The pitfalls in trying in the interpretation phase, I think, in terms of trying to draw using the ratings or the analysis behind the ratings to draw comparisons from one utility to another, or from one state to another. What are the nothing sinister in this, but what are the cautionary tales or risk factors that might be entailed in using rating agency analysis and reports to make these comparisons?
I think the biggest risk is again the kind of misinterpreting or not really getting what they're getting at. I'll be the first to admit that rating agency analysts don't always write and speak straightforwardly, and we like to use the passive voice a lot and try to soften things when we say things, because we're trying to be they're doing the right thing, but they don't want to they hate to be part of the whole process. They hate to be brought into things. They just want to be the umpire. They don't want to be playing the game and things like that. And so, you know, but in general, I think my point, you know, to the commission here or any regulator or any other stakeholder, and the whole thing is just look at the result. I mean, you know, you don't have to understand all the minutiae of criteria to get that. You make a decision and the company gets downgraded. It doesn't take a lot of familiarity with financial theory or credit analysis to figure out that something went wrong there, so to speak.
All right, very good. Thanks again. We appreciate your participation this morning.
You're very welcome. Thank you for having me.
Justin Grady.
Yes, yeah.
Thank you. Mr. Shipman, my question is on slide 55, and I know we sort of went past that one pretty quick, but I think there was something similar to this referenced in an earlier presentation or one of the earlier presenters. And so if you know, when you compare, you look at Kansas and you look at our RRA rating ranking or the SNL ranking, which is admittedly from an equity investor's perspective. You know, I think Mr. Ives mentioned earlier that, you know, I think Kansas, I think there's 13 or 16, or no, I'm sorry. I think it was like 34 states that are viewed more favorably than Kansas from an equity investor's perspective. And the reason I picked this slide to ask you this question is because, you know, the top of your, the title of this slide says equity and debt perspective. And as you know, S&P Global Ratings does a similar analysis of the states, and you know, what they rate, how they rate states is more a scale of you know, more credit supportive, very credit supportive, or highly credit supportive. And there is a category of most credit supportive, right? Well, the most recent ranking that we can find from S&P Global Ratings is from March of this year. There was also another one from November of last year. And I think the perspective from S&P Global Ratings is that of debt rating or debt investors. And S&P Global Ratings has Kansas ranked in the second highest category that you can be ranked as highly credit supportive. All right, so I count 6 states in the United States that are ranked higher than Kansas from a debt rating perspective or a debt investor perspective, according to S&P Global Ratings. And I think you used to be involved in the creation of that report and the authoring of that report, because I remember seeing your name listed as one of the primary authors when I've used it in the past. So with all of my, you know, sort of leading stuff out of the way, my question to you would be, why do you think that debt investors maybe view Kansas's regulation of utilities in a different light than equity investors, at least going back over the last several years? Thank you.
So thank you for your question, Justin. Yeah, I put this slide in here because I thought the broader perspective was really the relevant for this venue, because I was corrected by RRA a number of years ago that at some point they had broadened their perspective to take in both sides. When I was there, it was just the stock side of things that really mattered, so to speak. But they do bring in both. The other thing I'd say, if I was on the stand, I'd say subject to check, because I believe, if memory serves, I thought Kansas was maybe in the middle of everything, but I stand corrected if I'm not. And without looking at the write up and things like that, I wouldn't be able to tell you exactly why the ratings group at S&P has a higher opinion of Kansas regulation. But if they do, I don't. That's certainly not a bad thing. I think my point on this slide would have been, try to get more in the blue and away from the dark red, as a regulator. I think as you improve the quality of the regulation in terms of from this perspective, I think it's a very, very beneficial to ratepayers, things like that. And so I don't, without being able to see the details, I wouldn't be able to tell you exactly why the rating group has that opinion on Kansas. I would also say that, frankly, RRA is basically electric focused to be, because that's where all the investment is for the most part. And so the credit rating thing may be bringing in more of a broader view about, all different kinds of entities that a regulatory jurisdiction regulates.
Okay, thank you.
All right, thank you. I am not seeing any more hands for you, Mr. Shipman. So if you're done, we do thank you for the presentation. Very helpful to get that view. Mr. Ives, do you want to introduce, this is your final presenter, and if you'd like to introduce them, go ahead.
Yeah, so thanks. This is our final presenter, Dan Ford, currently with Citibank, but has like Mr. Shipman, has a number of years in the industry and a number of years evaluating equity investments in the space. So I'm gonna let Dan talk about his own background and experience and go through the presentation.
Thank you very much. Pleasure to be here, and I want to commend you for holding this forum because this could be done a lot more often, and it could alleviate a lot of misperceptions, when we do see orders and processes go forward. My background is about like Todd's. I understated it on the page, but I've got about 40 years in the business. Most of that was on the sell side, helping institutional investors with their equity investment process. Right now, I'm a vice chairman of natural resources, so broader than just utilities, as well as a managing director in the investment bank at Citigroup. So I'm on the private side, helping companies with strategic decisions and also with equity capital markets and overall asset allocation decisions. And so let's go to the next slide, which is 61. Because what I want to do is step back and put context around where we are right now. Utilities are the most capital intensive business in the country. Sometimes railroads edge it out, but right now electric utilities are. And as such, they have very, very long investment cycles. And so there isn't anybody really in the room who went through the last one, which was in 1970 to 1982. And now we're approaching one again. And this one is both being driven by demand pull and then also policy push. And so I want to give you a little bit of a roadmap for what we expect to come and why getting this question of regulation and returns right is critically important for what's ahead of us. So what we see from the demand side is that the reshoring of industrial demand, as well as the digitization of processes around the United States, is going to drive a very big increase in the need for electric infrastructure. And just to put that in context, right now, electricity serves about 20% of end use energy consumption in the US. We expect that that's going to better than double over the course of the next 15 years. And so the importance of electricity is only going to grow, and its importance to the economy is going to dwarf everything else if we get there. On the flip side, we're seeing a policy push, which is uneven across the United States, and it's partly being driven by the environmental movement and the idea of energy transition, but it's also being driven by what has been some forward progress in technology around solar, wind, batteries, as well as hopefully new nuclear, so small modular somewhere in the future. This shows a depiction of what we expect is going to happen to rate-based growth as a result of the CapEx that's needed to fuel this. And we see it as additive, and we look at it in four different thematics. The first thematic, which we've been living with since about 2010, is the systematic replacement of old units. So replacing older fossil generation, mainly coal, some gas, with on the margin renewables, wind and solar batteries. That will continue, but it will start to crest and slow its pace a little bit, depending upon what happens with subsidies and also with geography penetration rates. Where we are now is we're layering on grid infrastructure investments, and this is to feed that reindustrialization and digitization I spoke about. And we're seeing this really come faster than was expected and is faster than is depicted in the figure, mainly because of what's happening on the digital side with artificial intelligence and the need to get there quickly. And right now, the industry is growing rate base circa 8 to 9% per annum. We're going to add two more layers if we get to the finish line. The next layer, which has already started, is more penetration on efficient electrification. So that's going to be everything from more electrified industrial processes to heat pumps, to electric vehicles, to everything else really being fueled more on the electric format. And then finally, we're going to start to attack some of the hard to decarbonize applications with things like small modular nuclear, hydrogen, deep rock geothermal, other technologies that are really just on the drawing board but aren't there yet. And we expect that rate-based growth is going to peak somewhere in the late 20s, early 30s, in the 10 to 12% range. That's both exciting for an equity advocate, which I am, and scary because I don't know how we're exactly going to fund it. But I do think also that one of the key differentiators is going to be regulation, and we're going to see a much larger spread between the cost of capital of the beneficiaries of good regulation and those that are detracted by weaker regulatory constructs. Pete, we can go to the next slide. So this is a picture of where we are today, and this is a historical look as well as a forward look of CapEx. And what we're seeing right now is about $137 billion of CapEx spend through 2026. It's roughly 2/3 higher than the previous decade's average level, and that's going higher still. This graphic has not been updated for a conference that just took place last week in Florida at the Edison Electric Institute Financial Conference, where everyone's numbers went up, including Evergy's. And so these numbers expect that they go higher. I just wanted to put that in context. Let's go to the next slide. It was brought up earlier, and it's absolutely right. We've seen a declining trend in ratings across the industry now for several decades. And so the left-hand side of this chart just looks at the average rating, and this is at the distribution of ratings at the holdco level. And so right now the mode is triple B. The mode used to be back in 2000 A. And that's because systematically, as the growth has accelerated, utilities have actually leaned on their excess balance sheet capacity or perceived capacity to fund that capital expenditure at the lowest rate possible. We'll get to that in a little bit later in terms of how effective that's been in terms of cost for customers. But that leaves us with very little cushion, very little room for error. And so that's really why I'm here, because I'm the equity. I'm what fills the hole, and we've basically used as much of the debt capacity as we can, and the right hand side shows you that, and then you can see investors already beginning to differentiate between the credit that's still available by utilities in the multiples that they're paying for equity. And so on the bottom of the right hand side, I show you the top quartile as measured by FFO to pre-working capital debt, trading at about a turn and a half higher PE multiple than the bottom quartile. I expect that that's going to rise over time because of the next slide, Peter. This is what's scary. The opportunity is clear, but what's scary is that $137 billion of annual cash flow deficit, equitized at 25 to 30% to keep the bare minimum of that, top line equity ratio, means $34 to $41 billion a year of equity that needs to be funded for the regulated utility industry. The bottom of the page is some history and then a disappointing fact. So the history goes from first, how much have we issued a year? And you'll see on the slide that in 2018, we issued $19.8 billion of equity. That was singularly to restoke the balance sheet because of the Trump tax law change. That represented in the middle 7.9% of all of the equity sold by the S&P 500 that year. If we sell between $34 and $41 billion a year and rising every year, we're going to take somewhere around a 15% share of all of the equity the S&P sells. But utilities representation in the S&P has deteriorated over that period of time. We now represent 2.4% of all of the market cap in the S&P. So we're going to have to materially outshoot our weighting. And that means that we need to appeal to individual investors or institutional investors we don't know yet. And in order to do that, we need to offer them a return proposition that is attractive. Next page, Pete. RRA. So this is something that is a benchmark in the industry around how regulatory rankings work. And I don't want to pretend that regulation is the only thing that matters. It's not. It's one of actually 5 things, that really matter. The first is growth itself and the ability of the utility or the confidence in the market to actually deliver that growth on a linear basis. Right. The second thing is credit ratings. I already showed you that, a stronger cushion versus a weaker cushion gets paid for in lower cost of equity. Regulation is right up there with those other two as being very important. Then we have things like low probability, high consequence events. Wildfires, read that as. There's a big spread between states that are subject to wildfires and those that aren't. There's big project risk or big operational risk here. Nuclear is absolutely there. All they have to do is show you the cardiac chart of the events around Fukushima or the events around some of the U.S. incidents or Chernobyl. When a nuclear power plant anywhere in the world has a problem, everyone who owns one gets a cold. And that does represent a risk factor that we think about. And so what's added to what Todd and others have said about this RRA ranking is that it is represented, or it is reflected right now in the way that utilities are valued. And so what I've done on the right-hand side is I've plotted the next 12 months PE ratio, which is a measure of the cost of funds for equity against the ratings themselves, and you can see that there is a positive correlation between them. And I've also pointed out where Evergy lies in that matrix. And so Evergy overall is right now being treated as though it would have a higher cost of equity capital to fund its future than many of its peers. And just one other thing to point out about that, the equity markets, are really, it's a marginal market. And so everything really does matter. And that's what equity investors, basically spend all of their time thinking about is what makes a PE go up is simply there are more buyers than sellers until you get to a price where there's equilibrium and vice versa. And so right now the market is saying we've got some questions about Evergy relative to its class. Next
Dan,
slide,
we've got
please.
a question from Mr. Grady.
Yeah.
Thank you. Yeah, Mr. Ford, I don't think we've ever met. So welcome to Kansas virtually, and thanks for doing this. You mentioned, I think, that the PE ratio of a utility company is a is a measure or can be a measure of a cost of funds. Would I be correct in assuming that the way you would do that would be flipping the ratio upside down and do it earnings divided by price and look at essentially the earnings requirement, the earnings cost as a ratio, as a percentage of price? Is that how you would do that?
It's a fair question, but I think that methodology is too simplistic because it doesn't reflect the discounted cash flow of future growth and the risk of achieving that growth. And so you'd have to take that earnings yield, which is what that's called, and add to it the risk of achievement of the future growth that's on the page around future capital, around management execution, around the attractiveness of the industry relative to the rest of the S&P subsectors. So it's a more complicated answer than just an E over P. And so I just, that's the way that I would think about it.
Okay. Yeah, that makes sense. I assumed the answer would be something similar to that, because if we do the inverse of that price earnings ratio, that's going to come up with an earnings yield around, 6.65%. For next year, and obviously Evergy's authorized and earned returns are higher than that. Right. So
right. When I do, when you do an industry cap M, it's somewhere in the low tens right now. So that's also not a perfect incorporation of what I described, but that's closer.
Okay, thank you.
Pete, we can go to the next slide. So this is a concept that I wanted to introduce because the reality is we're kind of all on the same page here, at least in some regards, as opposed to being on competing sides of things. Because over time, the quality of service provided by a utility is actually positively correlated with its ease of access to capital. So customer satisfaction tends to go up in jurisdictions where companies can deploy more capital into the quality of their infrastructure. And that's because price matters. And I don't want to understate that in any way, shape, or form. But quality of service, SAIDI and SAFE, response for storms, community engagement also matter quite a lot to the satisfaction of the customer base within a jurisdiction. And now I'd layer on really in spades, the ability for state to attract the economic development in a way that's outsized relative to its neighborhood, because there's such an opportunity, and I think all states see it now, and you see it a lot in policy to try to compete for some of those jobs and roles and tax base, etc. Pete, 67, please. So this kind of brings a few of those concepts together. So what I've done here is I've just done an average of the below average, average, and above average RRA ratings. Show you the JD Power score, where they're definitely between the below average and average. It seems to be a case where really the best pupil gets all the attention, and so the above average states tend to have that best combination of a virtuous cycle where you see the customer satisfaction really aligned with the quality of regulation score. ROE obviously goes up with those rankings, which is one of the things we're here talking about, as does average equity layer, and also that next 12 months cost of capital as represented in a PE ratio. Next slide, Pete. And so this is a slide that I really want to bring forward, because I think I'd love to see it told more broadly to everybody, and really shouted from the rooftops. Utility product is an amazing bargain. Right now, electricity is number 12 on the list of household burdens. At the end of the last capital cycle in 1981, 1982, it was 7th. And so we've actually seen our relative ranking of share of customer wallet decline over that 40 years of in between. And we've seen the percentage of consumer spending decline for electric and gas combined to about 2%. from what was a high of just under 4.5% back at the peak of that last cycle. And so we have well overshot. If this was Netflix, our investors would be screaming for a rate hike, and deservedly, because they're providing extraordinary value, a decline in share of wallet for a product that, as I stated up front, is probably going to double in its utility and need across the United States. I think this is pretty important because we need to do a good job telling this story, because as we take share from other fuel sources, the electric bill will go up, but the net energy bill may not. One of my side jobs is I used to be on the board of the Electric Power Research Institute, and a lot of the analysis that they have done points at a more electrified U.S. economy, actually on an energy all-in basis, being at or more cost efficient than than one that we have today. I see that we have a
We have a
question.
hand. I'm going to make an editorial comment that I'm glad Evergy isn't Netflix, and I like Evergy's reliability of service better, given Netflix's performance the other night.
Fair enough.
So,
Fair enough.
Mr. Gatewood, go ahead.
I was just trying to ferret out from the graph. What is that, a median level of disposable income, an average level? Is that
So it's all in.
So it's average.
Yeah, so it's average, correct.
Right.
There's no question that we need to pay attention to our most needy payers. And I think utilities through regulation do an extraordinarily good job doing that. Rate design is important, there's no question. And we probably pay less attention to that than we should as investors and otherwise, and we should not. Pete? So this is my summary slide, and happy to answer questions. The first point is we're in a capital cycle for electricity, which hasn't been seen in 40 years and might be bigger. And the future is increasingly going to be electrified just because of the natural trends that we see, in digitization across the nation. Second, we're at an inflection point where we need to start to turn to equity markets for incremental funding. And the equity markets are more volatile than the debt markets. They care a great deal about what regulatory outcomes are. And because we're going to need to raise an outsized amount of capital relative to our representation in that market, investors don't need to buy at all. They can decide what to buy and what not to buy, and that's going to create winners and losers across the state and have implications on infrastructure investments. Third, regulation is a key differentiator. I guess I just said that, so I'm going to say it again. Access to capital and at good terms. Regulation is one of, as I stated before, sort of the 5 things that truly differentiate one utility from another, outside of the macro. And then finally, affordability is key. And here, we've done a very good job. It's not to say that we don't have work to do. Efficiency is absolutely necessary. Access to low-cost capital helps enable this outcome. So happy to answer any questions that you might have.
All right. So that is your final slide, Mr. Ford?
Yes, sir.
All right. Very good. Well, I found that to be a very interesting presentation. I will certainly agree with you that there is a lot of investment needed in the sector. We certainly want to make sure that Kansas gets its share of that investment.
Yes.
I will not hide that I bristled earlier at some insinuations that management may see the need to look at different jurisdictions based on our rate treatments, and that's going to be a discussion that's going to be ongoing, because I can assure you that it's important for Kansas to meet the needed investment for economic development. So, I mean, that's why I'm really glad we are having this conversation. All right, Mr. Gatewood has his hand back up. Go ahead, Adam.
Yeah, just trying to clarify on slides 63 and 64, are these specific to the operating company or a combination of operating company and holding company data?
This is holding company data.
Okay, all right. For both slides?
These slides are equity. So
Okay.
it doesn't have anything it's at the holding company as a result of it's the funding vehicle at the holdco for equity.
Okay, thanks.
Yeah.
All right. Nobody else is popping your hands up after that great presentation. I'm not seeing anything else. So Mr. Ford, I think you're off the hook. We do appreciate your presentation.
Right. Well, again, thank you very much for holding the forum. I think it's really terrific that you're doing this.
Yeah. Well, we look forward to continued discussions. I think you know, more interaction is better than less at a stage like this. So we appreciate your time. Mr. Ives or Mr. Campbell, I'm going to toss it back to you quickly to see if you have any concluding remarks.
So thanks, Chair, and I'll start. We might have others chime in. First I'd say, no intention, purposely to make you bristle. I certainly know that we are all aligned on, trying to unlock opportunities for Kansas, and that's why we're here, right? I mean, a historic opportunity for sure, on growth and economic development, and, a chance to really unlock some benefits for everybody in Kansas. But as we heard from Mr. Ford, right? I mean, some scary stuff left in front of us, right? A lot of investment we need to make, and a lot of access to capital, both debt and equity, that we've got to get to. So, not trying to, I would say, shoot for the fences and get a home run, but trying to make sure that we're all thinking about the right way to set policy in Kansas to unlock those opportunities. So for that, we certainly appreciate the time of all the parties and the time of the commission. And I'd let David say a couple words.
Great, thank you, and thank you again, Chair French, commissioners, and everyone on the participating today for your engagement and discussion. And I will note in the chat that Jim Zakura noted he was active in that last cycle. So Jim, well noted. And I'm in sort of that category of, gosh, I'm approaching 40 years in the industry, but Jim, you've got that experience set that is terrific. But it is a scary time. It's also an incredibly exciting time. So I would emphasize that we have a historic opportunity in our country and in our state to take advantage of growth opportunities. We do think that requires a level of investment. It requires attracting capital in ways that are different than cycles we've been in recently. So our focus here, know that there's some baseline commitments we absolutely commit to. That's to balancing affordability with reliability and sustainability, always keeping an eye towards affordability and regional rate competitiveness. We know how critical that is. We're also committed to maintaining investment ratings. That's a very important aspect of our business that we know you value and are going to keep a close eye on, and we're absolutely committed to that. And in that construct, what we wanted to have this dialogue with Ron was just an opportunity to discuss what we think are two very important items. It gets into a lot of policy and regulatory theory and law and that are very important, but also one where we want to ground it in. We have a historic opportunity. We just want to make sure that we're competitive so we can take advantage of all the opportunities we see for to help Kansas grow and take advantage of the opportunities. So we really appreciate the time today and the engagement and open discussion on this very important topic.
Well, thank you, Mr. Campbell. Thank you, Mr. Ives. Let me at this time just ask Mr. Grady, do you have any final concluding remarks on behalf of staff?
No, Chair French, I don't. I just appreciate all of the presenters and, the opportunity to have a good back and forth conversation. I do think this was helpful. I like the fact that this will be recorded and we can go back and spend a little more time thinking about some of these ideas. I appreciate Evergy's willingness to take questions throughout the presentation. I feel like that improve the usefulness of this exercise even more. That's all I have. So thank you.
You. Well, I'll speak for myself, and then I'll give the other commissioners an opportunity if they've got any final remarks. I have found this very helpful. I hope we will have more dialogue, whether it's in this setting or whether I can talk one-on-one with folks. Yeah, I struggle with some of these issues. We get stuck a lot in regulatory theory. I've spent a lot of my life in theory and in some of these financial models, but particularly as it relates to building a revenue requirement, and it is helpful for me to think about how that impacts other players. Doesn't necessarily always change the how you calculate a revenue requirement, but as a policymaker, it is very helpful to understand the context that we're putting this in. And so I have found this very helpful. Again, I think more dialogue rather than less is always good. When we have the opportunities, we don't always have the opportunities. So very much appreciate it. Let me ask at this time, Commissioner Keen or Commissioner Keither, any final comments you would want to make?
Thank you, Chair French. I'll be very succinct. My appreciation as well for the participation by all of the parties who have seen fit to give of their time this morning and their thoughts. What this really brings home to me is that we have before us as regulators a potpourri of balancing propositions, and I think maybe you've added some level of complexity and some hues of gray to what those balancing propositions are. But nonetheless, thank you all very much for your time, and we appreciate your coming to Kansas virtually.
Commissioner Keither, any comments before we conclude?
Just very briefly, thank you everybody for this. It was absolutely educational beyond belief for some of us that have not spent all of our time in the regulatory area in that way. But certainly thank you. And I agree with the chairman that the communication and conversation is very important. And I'm glad we've done this. It's really been helpful. Thank you.
All right. Well, with that, we will conclude our work study session today. Thank you, everybody, for your time.
Thank you.
Thank you.
Thank
Take
you.
care.